Good morning, everybody. And this is Jackie Ahrens. I just want to do a quick sound check to make sure that the sound is coming through okay and that you can see the screen in front of you. If you can see that, I wonder if you could just type a little yes or something into the chat box in front of you so that I know that everything is coming through okay. Yes, great. Okay, super, thanks. If one can hear, then everyone I know is able to hear, so that's lovely. Well, good morning to you all. A nice early chilly start on this really very cold day in May, and we are in for an interesting morning as we're going to be going through the tax amendments for our mid-year update. So now that I've greeted you all, I'm going to actually just put the video off and just focus on the slides. Okay, so our program for this morning is as follows. We're starting now, and we're due to run all the way through until lunchtime. So what we'll do is we'll just go for about 55 minutes in each session and then take a 10-minute break. We'll have a slightly longer break halfway through to have some tea or coffee at around about 11 o'clock. And yeah, then we're due to finish around about between 12:45 and 1 o'clock. Okay, so we have a lot to get through this morning. So the focus of this morning's presentation is on a mid-year tax update. And so we're going to be covering current topical issues. And if you do have any questions as we go along, you're very welcome to pop them into the question box or the chat box. What I might do is just pick those up at each break so that we can just keep the momentum of the webinar going. Otherwise, it does become a bit distracting from a presenter's point of view if I'm trying to read the questions and talk at the same time. I'm good at multitasking, but sometimes we don't want to push our luck too far. So if you do have questions, please, you're welcome to pop those into the chat box or the question box, and I'll pick up on them as we take a break at the end of each session or at the beginning of the following session. Okay, so the outline of what we are covering today. We spoke about the 2020 budget speech earlier in the year. There were some quite interesting proposals there around corporate tax, and there's a little bit of an update on that, which I'll talk about. And then, of course, we've had a lot of movement around tax relief in the COVID-19 pandemic, and we'll go through the latest version of that. There have been so many versions coming through, it's quite difficult to keep track. And even the version that I'm going to be talking about today, I did a quick check this morning to see whether we've had the final bill released yet, because this is based on the revised draft bill, that it's the latest version that we have. So we'll be running through that. But just a cautionary note that it is possible that there might be further changes coming through. And then we've got quite a few recent tax case judgments that we'll go through, which are all really interesting and highlight different aspects that taxpayers have been dealing with. Okay, so quite a lot to get through. Let's start with looking at the budget tax proposals. Now, we know that there's going to be a revised budget that's going to be presented on the 24th of June because the world has changed since the end of February, right? I mean, wow, none of us expected that we'd be where we are right now when we were watching the budget speech at the end of February. And of course, as bad as the economy was at that stage, things have become even more serious and really quite dire since then. And so many of the budget proposals have had to be revised. And we know that the Minister of Finance is going to give us a new budget on the 24th of June. So we await that with a fair amount of trepidation, but a lot of eagerness to see what he's going to come up with. But we have had the announcement in the meantime that some of the budget proposals have been postponed. So these relate specifically to corporate tax. And we had, if you recall the proposals in the 2020 budget speech, there was an announcement made that government would be looking at trying to reduce the corporate tax rate in the next, say, three to 5 years. Or whether that's still going to be a possibility in the light of the current economic developments, who can say? But that was the proposal at the time. However, in order to reduce the company tax rate, it would be necessary to broaden the tax base. And as some of the methods of broadening the tax base, the focus was on looking at a limitation of interest deduction and a limitation on the setting off of assessed losses. Now, if you look at the proposal that was put on the table around the limitation on the deduction of interest, and this all revolved around quite lengthy, around about a 40 to 50 page discussion document that National Treasury had put together, all motivating why we needed to have this limitation on interest deductions, how it would work, etc. And the proposal was that initially they proposed that for years of assessment commencing on or after January 2021, the net interest expense of certain companies, their deductions would be capped at 30% of taxable income before interest and capital allowances. So this concept of EBITDA, earnings before interest, tax, depreciation and amortization, but in a tax context, that would be taxable income before taking into account your deductions for interest and your capital allowances. So to cap that at 30% of that amount. And the idea was that this would apply to companies in multinational groups, carry forward if there was excess interest that could not be deducted in a particular year of assessment. The plan was to carry that forward and up to 5 years. So not an indefinite carry forward, but up to 5 years. There would be a sub-minimum amount, and there was some discussion in this discussion paper around what that sub-minimum amount would be. They had put forward amounts of in the region of 2.5 million or 5 million rand to say if your total interest deduction was up to that amount, you would be able to deduct the whole amount. You would not be subject to the capping. But the capping would, as I said, apply to companies and multinational groups, so not to absolutely every company. But these are all just proposals in terms of this discussion document. Now, of course, this would have quite a significant impact on the tax liabilities of many companies. Initially, they had proposed that this would come into existence from the 1st of January 2021, that the announcement has now been made that this would be pushed out to January 2022. I think there's just too much for everybody to deal with right now. And so this has been pushed out by a year, which means that we might not see the draft legislation on this for quite some time as well. Similarly, with the next proposal on the limitation on the set-off of assessed losses. So the proposal was that companies that had significant assessed losses, normally you would carry that assessed loss forward and set it off against the taxable income in the following year. And depending on the size of the assessed losses of these companies, it could be that they would not have any tax liability for many years to come because they would just keep carrying forward the assessed loss and setting it off. However, the proposal was that the set-off would be limited to 80% of taxable income in a particular year. And again, the proposal was that this would be effective from the 1st of January 2021. Indications are that this might also be pushed out to January 2022. So it remains to be seen. We're not quite sure yet. We are still waiting for the draft legislation to come out following on from the budget speech. And then it will be made evident as to what our actual proposals are going to be. But indications are that these two proposals will be pushed out for a year. So that is quite important in terms of planning, because if you're planning projected cash flow for the next few years and so on, obviously this makes quite a difference. Okay, so that's just the announcement on the corporate tax proposals from the 2020 budget speech. And of course, as I say, we are still waiting for the draft legislation so that we can see what is going to happen with the proposals in the budget speech. But this has now all been pushed out because we first need to get the revised budget speech on the 24th of June, and then we'll probably only get the draft legislation sometime after that. Right, so that's where we are as far as the budget proposals are concerned. Then the next thing to talk about is what is very topical at the moment, and that is the COVID-19 tax relief measures. And this has been quite a mission to keep track of everything as far as these amendments are concerned. We had the initial draft amendments put on the table in April. Those went out for public comment. There was discussion around that. Then there was a revised draft bill that went out at the beginning of May, and the due date for comment on that was the 15th of May. And so as we speak, SARS and National Treasury are busy working through the final bill, and we hope to see that, as I say, I would imagine early next week, if not towards the end of this week. So it's going to be interesting to see whether any of these proposals change. But there are a lot of things here that have remained pretty much the same from the first version of the bill. There have been a couple of new things that have been added, and there have been a few enhancements that have been made. So if anything, if there are any further amendments that come through, I would expect that it might just be additional relief. I can't see that they're going to take away any of the relief that is currently on the table. And I know many taxpayers, payroll software providers and so on are quite nervous about making all the changes that we see in the revised draft bill, because it's not yet a final bill, let alone promulgated. It's not yet an act. And so people are a little nervous about acting on this, but things are moving so quickly. And of course, the economic situation is so challenging that it really is incumbent on, let's say, employers to claim what they can claim under the enhanced employment tax incentive, to use the deferral of the employee's tax payments. So even though this hasn't been promulgated yet, we have the certainty that SARS has accepted that this is how it is going to work. And so when they say you're not going to face penalties and interest, indeed, it is the case that you would not face penalties and interest if you follow the deferral that is provided for in the revised draft bill. So the measures that we'll go through this morning are as they stand today. This is what we know, but it could be that by tomorrow we have another version of the bill. So I have to just put out that cautionary announcement that things are subject to change. But this is just the nature of our lives right now. Of course, everything is so uncertain. Nonetheless, the key tax relief measures that are available are as listed on the slide there. We see the enhanced employment tax incentive, skills development levy holiday, deferral of various types of payments. Notice that VAT payments are not covered there. There's no deferral of VAT payments, but certain other types of tax payments. And then arrangements for other late payments. And then the Solidarity Fund and the COVID-19 relief organizations, the tax dispensation given there, a couple of relief measures on VAT, and then to enable people to access some of their savings, they have provided for expanded access to living annuities. Okay, now, before I go into all of these tax relief measures, it's quite important to note that there are some terms and conditions that apply. So these measures don't automatically apply to all taxpayers. Some of these measures apply, let's say, to all employers, like the skills development levy holiday, and even the employment tax incentive. But others only apply to certain taxpayers. So one has to just be a little bit careful about whether a particular taxpayer actually qualifies for the relief. And there is a blanket requirement that runs through all of this tax relief, pretty much, and that is that the taxpayer must be tax compliant and up to date with all of their tax obligations with SARS. All right, so let's go through and have a look. What is this general tax compliance? Because we see this coming through, as I say, in almost all of the tax relief measures. There is the requirement that the person must be tax compliant. Now, what do we mean by tax compliant? Well, we saw this being addressed in the amendments that came through last year, because we saw that SARS moved from a manual system where they used to issue the tax compliance certificate to this online real-time system where you can go in and check your tax compliance status. And it's literally as of the time at which you're checking it. So it might be that you were tax compliant yesterday, but today you might no longer be tax compliant. But of course, to access these tax relief measures, we must be tax compliant as per section 256.3 of the Tax Administration Act. And that provides, and this is really the requirement in order to get your tax clearance, as it were, your tax clearance certificate, you would have to meet these same requirements. So you must be registered for any taxes that you might be required to be registered for under a tax act. So if you're required to be registered for VAT, you're registered for VAT, income tax, etc. And then no outstanding tax debt, except they do make provision for certain tax debts which have been managed, let's say. So you might have a tax debt that is owing to SARS, but you have made payment arrangements and you've agreed to installment payment arrangements with SARS under section 167 of the Tax Administration Act. Or the debt has been compromised under Section 204. This is normally when taxpayers are basically insolvent and they're totally incapable of repaying the debt, then SARS can compromise that debt. So it's quite an extreme measure, but nonetheless, it is another form of managing a tax debt. And then it talks in subparagraph 2 about debt that has been suspended under Section 164. And that is talking about where you have a dispute with SARS. And as you know, we have the pay now, argue later principle. So if you do have an objection with, you lodge an objection or appeal with SARS, that does not suspend the obligation to pay the debt, right? And so it is important that you apply for a suspension of payment. And that means that the debt is suspended. SARS will not take collection steps towards recovering that debt while the dispute resolution process is underway. And of course, it does also give you the protection, and that's what's covered in subparagraph 3, that from the date that you lodge that request for suspension of payment until 10 business days after the suspension is revoked, SARS cannot take steps to recover that debt. So they can't notify the bank to pay the money out of the bank account or do anything like that. They can't attach the assets or anything like that. So they can't recover the debt. So you have that protection during that period. So if you have applied for a suspension of payment, then that's another way in which that debt has been managed. So although there is a tax debt, it is under that form of management in terms of being suspended. And then under subparagraph 4, it talks about a de minimis amount. So if it's a very small amount of debt, and that de minimis amount is amount of 100 Rand, which is really next to nothing. All right, so if you have a very small amount of debt, that would not count against you, less than 100 Rand. So if the taxpayer does have tax debt, and when we talk about tax debt, we are talking about an amount that is owing to SARS, and it's basically gone past the due date for payment. All right, so if you have an assessment that has been raised on a taxpayer and the due date for payment was the 30th of April, we are now in May, you now have effectively an outstanding tax debt, okay, because it's gone beyond the due date for payment. But if the due date for payment was the 30th of June and we're standing now in May, this debt is not yet due, so it wouldn't be shown as an outstanding tax debt. Okay, so if the taxpayer does have an outstanding tax debt and they have not made arrangements with SARS to manage that debt under the, let's say, payment arrangements or suspension of payment or compromise agreement, then that would mean that the person is not regarded as being tax compliant. Okay, so that's the second requirement, is around no outstanding tax debt. And the third requirement is there must be no outstanding return unless an arrangement has been made with SARS for the submission of the return. Okay, so in order to be compliant, you must meet all of those requirements. And we can gloss over that, but just be very careful about this, because it could mean as we go later into the deferral arrangements, and you're entitled to a deferral, let's say, of some of your employees' tax payments, but you're only entitled to the deferral if you are tax compliant. Now, if there's some payment that is outstanding, even if you qualified for the deferral in 1 month, and then there's another amount that becomes outstanding during the next month, it means in the following month, you're not entitled to that deferral any longer. So it's very important, especially when you're making use of the deferral arrangements, etc., that you maintain your tax compliance all the way through. Otherwise, you're going to have problems in terms of having deferred certain payments, but now you're not eligible for that anymore because you're no longer tax compliant. All right, and much of this, of course, the registration is probably something that has been done, but you need to manage the outstanding tax debt and the outstanding returns. Right. Then just on a practical note, and this is basically drawing from the SARS website, how do you check to see if you're tax compliant? To determine if you're tax compliant, well, you can request your statement of account from SARS, or you can have a look at what SARS calls the MCP page on e-filing, which stands for My Compliance Page. And you can actually go onto the SARS website. If you do a search for this, or you'll find it through the administration section, where you actually look for tax compliance, and it takes you to, it'll give you the link to go through to your compliance page, where you can actually check to see if you're tax compliant. Or you can phone the SARS call center. Many of you who are watching this webinar today are tax practitioners, so you might well be quite familiar with checking your MCP page on e-filing. And for other taxpayers who are not that familiar with using e-filing, they might want to phone the call center or request a statement of account. All right, so SARS makes it clear that you are able to do that to check to see if you are tax compliant. Of course, we know that things can change on a day-by-day basis, so it's going to be very difficult to be phoning SARS every day to see if you're tax compliant. That's obviously not doable. But it might be that you just want to check at a point in time, and then from then onwards, you are able to manage to know whether the person is tax compliant or not. All right. Then we're going to talk about the employment tax incentive and the enhanced employment tax incentive. And before we get into that, I just want to cover very briefly, how do you know whether you are even entitled to an employment tax incentive? So the issue is that the Employment Tax Incentive Act lists what they call qualifying employees. And those qualifying employees are, in essence, employees between the ages of 18 and not more than 29. All right. And they are, generally speaking, people who have South African IDs, etc. And in order to check whether your particular employee qualifies for the employment tax incentive, SARS has provided this tool. So you can copy and paste this link into the SARS website, and it'll take you to a little sort of Q&A where you can put in the information. For example, it says, is your employee a domestic worker? And if you say yes, it'll come back and say, well, that doesn't qualify for the employment tax incentive. All right. So it goes through those kinds of questions. So the employer has to be registered as an employer, mustn't be a part of the government, so it must be part of the private sector, and it mustn't be a public entity or municipality. And those are basically the employers that would qualify for the ETI. And then generally speaking, I'm going to talk about some enhancement measures just now, but the normal rule is that a qualifying employee must have a South African ID, must be between the ages of 18 and not more than 29. And notice here that the employee's age is determined at the end of the month, because ETI is claimed on a month-by-month basis. So if you have an employee who turned 18, you would be able to claim the ETI for them, but it'll end in the month before they turn 30. All right, so they must not be more than 29. So if the person is 29 years of age and they're going to turn 30 on, let's say, the 22nd of August 2019, this is going back to last year, then you would claim the ETI up to July 2019. But you can't claim it in August, because that's a month in which they turn 30. So they must be not more than 29. Once they turn 30, from that month in which they turn 30 onwards, normally speaking, you would not be able to claim the ETI. Okay, so that's the normal rules, is around the 18 to 29. And then normally, and even currently, it would not be a domestic worker, and the employee must not be a connected person to the employer. The normal rule is that they must have been employed on or after the 1st of October 2013. And then they must be paid at least the minimum wage that applies to that particular employer. So if the employer is subject to the National Minimum Wage Act, or if it's subject to a bargaining council agreement for that particular sector, or if there's if the employer is not covered by any of those prescriptions, then they must be paid at least 2,000 Rand per month. Okay, so there's those requirements around minimum payments. So those are the normal requirements in order to qualify for the ETI. And as I say, SARS has this tool that you can use to check whether you do qualify for a particular employee. So as I say, the normal rule is that you're talking about employees 18 to 29 years of age. And the other important thing is that the normal rule is that you only get the employment tax incentive for the first 24 months of employment. You'll notice here that I talk about SEZs. If you have a company that qualifies for the Special Economic Zone incentive, their qualifying employees are not restricted by age. So as long as they meet all the other criteria, there could be any age for companies qualifying for the SEZ. But apart from that, you're talking about employees between 18 and 29, and only for the first 24 months of employment. But now, part of the enhancement of the employment tax incentive is that there's an additional incentive for these existing qualifying employees, all right? And then there's also an additional incentive if you employed any of these qualifying employees for more than 24 months. So for this, there's a 4-month period that you can, again, get the ETI for those employees. And then you could also get the ETI for other qualifying employees. So they must meet the other requirements. They must have a South African ID, not a domestic worker, not a connected person, and so on. But they could be aged from 30, not more than 65 years of age. Okay, so this is where the enhancement comes in, is that you get additional ETI on your existing qualifying employees. And then you also get ETI on other employees that wouldn't normally qualify for the ETI. So they could be because they've gone beyond the 24 months or because they are above 29 years of age. But this enhanced employment tax incentive applies for 4 months, April, May, June, and July. Okay, so it's important to bear that in mind. This is not an ongoing thing. And it's going to be interesting to see when they come out with the final bill as to whether this is in fact going to end at the end of July, or are they going to extend this? The key thing is that employers would claim the employment tax incentive monthly. Previously, we had to wait until you did the 6-monthly employees tax reconciliation through the EMP 501 form, and only then, if there was any excess ETI, would it get paid out by SARS. But part of the relief that is on offer through the COVID-19 tax relief bill is that your ETI could be claimed monthly. So if your ETI that you are claiming is more than the employee's tax liability that you have to pay to SARS, then SARS would actually pay that amount back to you, that excess. So let's say your ETI was, for argument's sake, 50,000 Rand, that you only had an employee's tax liability of 20,000 Rand, that excess of 30,000, SARS could now pay back to you, and it could be done on a month-by-month basis. You no longer have to wait until you submit the 6-monthly reconciliation. Okay, so this monthly payment, that again came into effect from the 1st of March, and runs through to the end of July 2020. Now, there are still compliance requirements that the employer has to be registered as an employer. You see there on the 1st of March 2020, and you've got to be compliant and up to date with all of your tax returns, etc. There are even compliance requirements within the Employment Tax Incentive Act that apply. All right, so you've got to meet all those compliance requirements in order to get the ETI. And what you would normally do is you would set that ETI off against your employee's tax. As I say, if there's an excess, you could even get the amount paid back to you from SARS. So the amended ETI formula. So we said that the first measure of relief is that there's an additional ETI on your existing qualifying employees. And remember, we said that you can only claim that for your existing qualifying employees for the first 24 months of employment. So the way that the ETI works is that we've got one calculation for the first 12 months of employment, and then for the second 12 months of employment, this is on your normal qualifying employees. Pretty much the benefits, they would normally half. So what's come through here is that ordinarily, let's have a look at that first line. If you were paying monthly remuneration up to less than 2,000 Rand per month. Now, of course, this is less than the National Minimum Wage Act. So this would only be possible if you had a specific wage agreement for the sector that allows payment of less than 2,000 Rand per month. And this could be, for example, in the agricultural sector, that they might have this type of arrangement, that maybe the minimum wage is 1,500 Rand a month, etc. So if you were paying this person 1,500 Rand a month, ordinarily your ETI would simply be 50% of the monthly remuneration. But the enhancement that's come through here is that you now get this extra 750 Rand per month. All right, so if you were paying an employee 1,500 Rand per month, remuneration, then your ETI would be 50% of that. In other words, 750 Rand plus 750. So you would actually get an ETI of 1,500 Rand on that particular employee. All right, so you can see how in some circumstances the ETI could add up to more than what the employee's tax is that needs to be paid over to SARS if you have a lot of lower paid employees. Because bear in mind, even up to 6,500, this person is still earning below the tax threshold. Or so there wouldn't actually be any employees' tax on these employees, and yet you are able to claim the ETI. But the key enhancement here, and I know this looks maybe a little messy, but I'm trying to show you what changed on these tables, is that they have actually added in this extra amount of 750 all the way across the board. And when you get to the formula, if you're paying above 4,500 but less than 6,500, so up to 6,499 basically, then you work out your ETI according to a formula. And the way that this formula works is that the higher your remuneration goes above 4,500, the less your ETI is. So if, for example, you were paying an employee, let's say 6,400 Rand per month, okay, then the way that you work out the incentive, 6,400 is your monthly remuneration, that is C. Then you subtract D, which is 4,500, okay, and then you multiply the difference by B, which you can see there's 875, and then you subtract that from 1,750, and you'll see that you would only get 87 Rand 50 as your ETI. And if you were paying this person 6,500, you would in fact get an ETI of nil. So the ETI peaks at 1,750 per month when you're paying the person around 4,500 per month, and then drops down as your remuneration increases to the point where at 6,500 you're no longer getting any ETI. But the enhancement is this extra 750 per month per employee. And you'll see even in the second 12 months, so this is the second 12 months of the 24 months of employment for your normal qualifying employees, again, you see this extra 750 per month coming through. All right, so that's for your normal qualifying employees between the ages of 18 and 29. Then we've got the additional ETI, and this is for the 4-month period. Normally, these employees would not get the ETI, but now you will get the ETI for these employees for April, May, June, and July. And this will be for your employees 18 to 29, but they've been employed for more than 24 months, and employees aged from 30 to not more than 65 years of age. All right, so on these employees, you're going to calculate the employment tax incentive as follows, and you'll see if you're paying less than 4,500 per month, you get a fixed ETI of 750 per month per employee. If you're paying from 4,500 to less than 6,500, you're going to work out according to this formula again, which is basically going to be anything from 750 down to basically zero. And at the point where you pay the person 6,500 Rand a month or more, your ETI is nil. So these ETIs are really only for your lower paid employees. You're not going to get the ETI for all of your employees. Certainly, you're not going to get an ETI for any employee that's earning 6,500 Rand a month or more. But for employees that are earning less than that, you can claim the ETI. There's no special requirement other than that the employer must have been registered as an employer and, of course, must be tax compliant. And then what you would do is you would claim the ETI on your monthly employees tax form, the EMP 201 form. So on the SARS website, they do give this information of how do you claim this additional ETI. So you simply go ahead and claim it. If you work out that you're an employer who is entitled to claim this additional ETI, even if you've never claimed the ETI before, and you realize that now you can claim it, you just go ahead and show the ETI on the EMP 201 form. So you'd calculate the ETI as per the rules that I've just explained to you. You calculate the full ETI plus any additional ETI for those additional qualifying employees and show the amount on the EMP 201. Okay, and then what effectively happens is that ETI reduces the amount of employees tax that you have to pay over. So SARS gives this example of an employer that has 3 employees. They're each earning 4,500 Rand per month. And there's employee A, age 25. So that's your normal qualifying employee. He's in his 6th month of employment. So again, fits within the first 24 months. So it's your normal qualifying employee. And then you've got employee B, who has already been employed for more than 2 years. So although he's under 29 years of age, you've already gone past the 24-month employment period. So you would not normally get an ETI for employee B, but now you will get an ETI under the extended relief. And employee C is 34. So again, you would not normally get an ETI on this employee. But for these 4 months, you can get the ETI. So let's assume that the employees were each earning that remuneration as I stated. So employee A, you would get your normal ETI would have been that 1,000 Rand per month. But now the additional ETI is that extra 750. And on employee B, you get the additional 750. Similarly on employee C. So the normal ETI that would have been claimed would have been 1,000 Rand. But now you claim the additional 2,250. And so in total, you're going to claim this ETI of 3,250. And that is literally like getting cash back from SARS, because you then set that 325 off against whatever PAYE you have to pay across to SARS. So you'd have all your other employees, you would have worked out the employees' tax that has been withheld from all of your employees for the month. Normally, you would have to pay that across to SARS, but you reduce it by the amount of your ETI. And you would show that amount in the field for ETI on the EMP 201 form. Okay, now if your ETI, let's say in my example, those were your only 3 employees, right? So you didn't really have any employees' tax to pay to SARS, but you are entitled to that ETI. So normally, as I said, you would have to wait to do your 6-monthly employees' tax reconciliation before you get the payment from SARS. But during this COVID-19 relief, SARS has undertaken to pay this amount on a month-by-month basis. So they have said that they will pay the ETI refund within 10 days after your EMP 201 has been successfully processed, okay, indicating that you have provided all the necessary information and so on. Provided you are fully tax compliant, going back to what I was saying there about what makes you tax compliant, and of course, provided you've not been selected for an audit and SARS has valid bank details for you. All right. Now, if it turns out that you're not compliant for a particular month, there might just be a payment outstanding, something of that nature, then you would not get the ETI credit paid out to you. It will be carried over to the following month, and then it will really only be paid to you at the end of the reconciliation period. Okay, so the only way you're going to get the ETI refund paid on a month-by-month basis is if you are fully tax compliant. And, of course, provided that you're not selected for audit, etc. Okay, now this additional ETI. So when we talk about the additional ETI, in my example earlier, I said the normal ETI would have been 1,000 Rand, but now you're getting the additional 2,250 for the 3 employees. So that ETI, whatever ETI you're claiming, the whole amount of the ETIs have to be shown on the RP5 certificate. So they have to be coded and shown on the RP5s. So there's an additional qualifying option that must be used for employees who are not normally eligible for the ETI, either because of the age restriction, that 18 to 29, or because they've already been employed for the 24 months. So you've got 2 sort of additional ETIs. You've got the additional ETI on your normal qualifying employees, just that extra 750 per month. And then you've got, shall we call it the enhanced ETI for employees that would not normally have qualified. All right. So for those employees that would not normally have qualified, that needs to be shown separately on the RP5. All right, so that's the enhanced ETI, and the whole idea with that is to give a bit of cash relief for employers, that they can actually get a little bit of cash back from SARS, and it is an incentive, and it really is just giving cash relief. You would not have to pay that ETI back to SARS. All right, it's just a straight-off tax relief. Another form of straight-off tax relief is the Skills Development Levy holiday. And this was an additional measure that was introduced in the revised draft bill. And this is available to all employers as long as you were registered on the 1st of March 2020. And this, because it was a measure that was introduced in the later version of the bill, it came through as a kind of an afterthought. This doesn't apply from April to July like the other incentives. This applies from May through to August. So it's a little confusing. Remember when we spoke about the employment tax incentive, the enhancements we said applies for April, May, June, and July 2020. Well, the skills development holiday applies for May, June, July, and August. Okay, so it doesn't apply for April, but it carries on into August, whereas the ETI ends at the end of July. So the skills development levy holiday, it simply means that the employer does not have to pay the skills development levy for that particular month. All right, so it saves the employer quite a significant amount of money because it's that percentage on your payroll that you no longer have to pay across to SARS. So normally you pay 1% of the payroll cost as a skills development levy, but for this 4-month period, the employer does not have to pay it. So there's zero liability. This is not a deferral, it's an actual type of exemption. All right, so you would not have to pay this at all. So you have no liability to pay the SDL for this 4-month period. All right, so that does save the employers a bit of cost. And again, that's available to all employers. It's not only small businesses or below a certain threshold or anything. All employers qualify for this SDL holiday. And again, how do you claim it? Well, when you fill out your EMP 201 for that month, let's say for May, you're going to be submitting this EMP 201 by the 7th of June. When you complete that EMP 201, you will see that the block for the SDL levy is actually blocked out by SARS. They've already kind of pre-blocked it, so that there is no SDL that shows up on the EMP 201 form, so that there is simply no liability for those 4 months. So that's quite nice that there's a bit less that has to be paid across. Okay, then we get on to the next types of relief, and these are in the form of deferrals. And the first one is the deferral of PAYE and provisional tax. And what is common to both of these deferrals is this concept of a qualifying taxpayer. So now we need to be careful that the deferral relief only applies to certain taxpayers. So we said the ETI applies to any taxpayer, the skills development levy applies to any taxpayer as long as they're employers. But now these deferral provisions only apply to what we call qualifying taxpayers. To be a qualifying taxpayer for the purposes of the PAYE and provisional tax, we're talking about a company, trust, or individual. In the case of PAYE, it can even be a partnership, all right? That doesn't apply for provisional tax because we know that provisional tax, each partner has to look after their own tax affairs, all right? But for employees' tax, it could be company, trust, individual, or partnership. Then it must be a taxpayer as defined in the Tax Administration Act that conducts a trade. And then in addition to that, gross income does not exceed 100 million rand for the year of assessment that is going to end between April 2020 and March 2021. Very important to pay attention to the year of assessment. So if we've got a June year of assessment, then we're saying what is the gross income for the year of assessment ending 30th of June 2020? That must not exceed 100 million rand. And if we have a year of assessment ending February, then we are talking about the year of assessment ending February 2021. Okay, so if it was June, it's June 2020, and if it's February 2021. For that year of assessment, we have to be sure that the gross income is not going to exceed 100 million rand for that year. Okay, so there's the threshold. So we're talking about small and medium-sized businesses. Then we look at the mix of income. It's also important. And we can see that the gross income for the year of assessment cannot include more than 20%. And I've shown you the change here from the original bill to the revised draft bill. They've increased that from 10 to 20%. So you can't be deriving more than 20% of your gross income in the form of, let's call it investment income. All right. And that's, to be specific, we're talking about interest, dividends, foreign dividends, and rental. However, if you have a property owning company whose main business is letting property, then you don't have to worry about the fact that you're getting more than 20% of your gross income in the form of rental. Okay, we're talking about rental when it is a type of an investment income. All right, so if you have an investment company that holds shares and property, and that company is deriving its income in the form of interest, dividends, and rental, you can see that that type of investment property, even if their gross income is less than 100 million rand, they are getting more than 20% of their gross income in the form of investment income. They would not qualify for the deferral relief. Also, just be careful with the provisional tax deferral relief. If you're looking at an individual who is a provisional taxpayer, they might well be carrying on a trade. And remember that earning a salary is a type of a trade. But a provisional taxpayer who is earning both remuneration and other income, and it's the other income that's making them a provisional taxpayer, if their gross income is derived more than 20% in the form of remuneration, you see that last line under paragraph C. If they get more than 20% of their gross income in the form of remuneration received from an employer, then they will not qualify for the deferral relief on provisional tax. So many of our provisional taxpayers, most of their income is derived through remuneration. And in fact, we're not even talking most, we're saying 20%. If more than 20% of your gross income is derived by way of remuneration, you're not going to qualify for the deferral relief, even though you are a provisional taxpayer. So be careful about this. I do anticipate a bit of confusion here, that people tend to think that just because they're a provisional taxpayer, they're entitled to the deferral relief, but that is not the case. You're only entitled to the deferral relief if you fit into this definition of a qualifying taxpayer. And of course, the last item is that the person must be tax compliant, as I spoke about previously. All right, so if you're an employer and you qualify in terms of these criteria that I've mentioned here, then you would qualify for the deferral of PAYE relief. And if you're a provisional taxpayer and you fit into this definition of qualifying taxpayer, then you will qualify for the deferral of the provisional tax payment. So it's quite possible that for some companies and businesses, they might be eligible for both deferral of PAYE and deferral of the provisional tax. Now, let's have a look and see how the deferral of the employee's tax works. And here again, there was a change in the revised bill where they've actually increased the amount that can be deferred. So qualifying taxpayers that are resident employers or a representative employer that is registered by the 1st of March 2020. So those are the criteria to qualify for this deferral. And you must be tax compliant, remember, not part of the government or any municipality. And the relief that's on offer is that you can defer part of your employee's tax. So in a particular month, you withhold your employee's tax. Normally, you have to pay that whole amount of employee's tax to SARS by the 7th of the following month, right? Under the deferral relief for the months of April, May, June, and July, so the April payroll payable on the 7th of May, and so on, you only have to pay 65% of the employee's tax. So if you withheld 100,000 Rand of employee's tax during the month, normally you have to pay that 100,000 across to SARS by the 7th of the following month. But under the deferral arrangement, if you qualify, you would only have to pay 65,000 across to SARS, and you would defer the other 35,000. Now notice, this is a deferral. It's not an exemption. So you do have to pay this back to SARS at a later stage, but you don't have to pay it now. What you do is for these 4 months, April, May, June, and July, you can hold back up to 35% of the employee's tax, but then you have to pay that back over 6 months from September through to February. So if you held back 35,000 Rand per month over 4 months, then that's basically going to be 35,000 Rand for April, again for June, again for May, June, and July. So for 4 months, you would have held back a total of 140,000. You still owe SARS this 140,000. You then split that into 6 equal monthly payments, 23,000 Rand each, and you add that onto your normal employees' tax that you pay from the 7th of September through to the 5th of February 2021. So as long as you pay 65%, at least 65. I mean, you can pay the whole amount of the employee's tax if your cash flow is healthy, but your minimum requirement is that you have to pay 65% of the employee's tax by due date, May, June, July, and August. So May in respect of the April payroll and so on. And as long as you make those payments on time, there'll be no penalties or interest. Okay. However, when you have to pay this deferred amount in 6 equal installments, remember that you must then make those payments from September through to February. As long as you make those payments by due date, then again, no penalties or interest. But if you miss any of those payments, then penalties and interest will apply. And the other thing to be careful about is that if you are using the deferral arrangement, but you end up anytime between April, May, June, and July, when those amounts are due to be paid to SARS in May, June, July, and August, if you miss any of those payments or you make any of those payments late, then be careful, because you're now no longer tax compliant and you're then no longer entitled to the deferral relief. So the deferral relief is only if you are tax compliant at the time when the payment is due. Notice, and this is a point that SARS makes in their COVID-19 tax relief user guide, which is a very useful guide for you to download from their website. They make the point that the 35% deferral is only applicable on the PAYE liability declared on the original EMP 201 return submitted to SARS. If you then change that, or you do a request for correction, then any additional PAYE liability is not subject to the 35% deferral. So it's only the amount that you declare when you do your first submission of the EMP 201 for that particular month. How to claim that deferral? Well, you claim it on the EMP 201. But now this is where things can seem a little bit confusing. On the EMP 201, you have to show your full PAYE liability. So if your employee's tax that you withheld in a particular month was a total of 100,000, was the example I was using, you would show that full amount of 100,000 on the EMP 201. Okay, so it must show the full PAYE liability. However, you would manually calculate how much you actually need to pay to SARS, and you need to pay at least 65% to SARS. So you could do that manual calculation, pay the 65% to SARS, or you could submit the EMP 201 and then wait for SARS to issue a statement of account, and they will show you on the statement of account the 65%. But of course, to do that, you've got to leave enough time that you've got to get that statement of account back from SARS in time to make the actual payment to SARS by the 7th of the following month. So it would be much easier, I think, just to calculate the 65% of the total PAYE liability. And then you have to add on your skills development levy for the month of April. We know that for May, June, July, and August, there's no SDL. And then you also have to add on any UIF that is payable. All right, so you would work out what you actually need to pay to SARS, taking into account your 35% deferral. And then if you want to just be sure that you've got everything right, once you've made the payment, give it a couple of days and then request a statement of account so that SARS can confirm that your payment is correct. Okay, and as you can see, that has brought us up to coffee time, or a bit of a leg stretch. So take a 10-minute break and we'll see you at 10:05. Thanks. Welcome back, everybody. I hope you managed to have a little bit of a leg stretch. It's just good to get up and move around every now and again, especially since we have a whole morning's webinar this morning. Right, so let's get back into it again. We were just finishing talking about the deferral of the employees' tax, and the point being that you can defer up to 35% of your employees' tax payments for the 4-month period, April, May, June, and July. But you would then have to pay that back in the following 6 months. Okay, so quite a nice benefit, again, just to give a bit of a cash flow benefit to companies that are struggling during this economic crisis that we are seeing as a result of the COVID-19 pandemic. Okay, now in terms of claiming the deferral of employees' tax, as we said, you're going to claim that. Basically, you show on the EMP 201 the full amount of employees' tax for the month. But then you would calculate and pay 65% of that. But remember, 65% of the employees' tax plus any SDL, if you're talking about April, and any UIF you need to add on as well. So the 65%, you don't apply that to the UIF. You still have to pay the full amount of your UIF payment. All right, if you pay the minimum required PAYE late, so this is what I was saying, be careful, because then you are no longer tax compliant, and it means that you're going to forfeit the COVID-19 tax relief. All right, and SARS would then impose penalties and interest. So be very careful about that. You do have the deferral relief, but you still have to make the required amount of the payment on time. So you can do your payment and then request a statement of account that SARS says 48 hours later to ensure that SARS has not revoked the discount due to non-compliance. Because as we know, sometimes you think you are tax compliant, you think everything's fine, but for some reason, SARS has other ideas because they know about some or other tax return that they think is outstanding. So it's a good idea just to check on the statement of account to make sure that your idea of what you're entitled to in terms of the deferral equals what SARS has shown on the statement. Okay, note, and this is again from SARS Guide, no amounts reflecting or indicating the COVID-19 tax relief will be displayed on the EMP 201. Okay, and that's why I said it can be a little bit confusing, because the EMP 201 does show the full liability for the PAYE, but in terms of what actually has to be paid, you would then apply the 65% to the employee's tax, add on the SDL and UIF. Okay, so for example, and this comes from SARS Guide, I'm just going to pick up one line here. If your PAYE liability was, let's go to the last line, if it was 54,000 Rand for the month, you would calculate a 35% deferral, 18,900, which means you have to pay 35,100. If this was for the month of May, June, July, or August, there would be no SDL liability, but you would still have a UIF liability that you need to add on. So what you would have to pay to SARS is the 65% of employees' tax plus the whole UIF liability. And so the total amount payable on the 7th of June would be 36,720. Okay, so just a little example of how that works. All right, now, if you are claiming both the deferral of employees' tax and you are claiming the enhanced ETI or on your employees, it is possible that you can get both benefits, all right? As long as you're a qualifying employer, qualifying taxpayer, you get the PAYE deferral relief, and all employers, as long as they are tax compliant, get the employment tax incentive relief. So to claim the ETI, you would obviously show on the EMP 201 form the full PAYE liability. You show how much ETI you are entitled to. Then you take 65% of the PAYE liability. You have to calculate this manually, or unless you've got a nice software package that's doing this for you. You take 65% of the PAYE liability, deduct the ETI that you're entitled to, and then add on any SDL, if it was for the month of April, and any UIF. Okay, and then that's the amount that you'd have to pay. So let's have a look at this example again from the SARS Guide. Again, I'm going to just take the last line. If you take PAYE liability for the month, let's say it was 54,000, and you've got an ETI of 20,000. So the amount of PAYE that you actually need to pay to SARS is 65% on 54,000, 35,100. Deduct the ETI of 20,000, and that leaves you obviously with 15,100. that you need to pay to SARS, add on the UIF of 1080, and that gives you the total amount payable to SARS by the 7th of the following month. Now, if your ETI exceeded your employee's tax, you could claim that from SARS, and based on the current dispensation for this ETI COVID relief, you should get it paid out to you on a month-by-month basis. Otherwise, usually it would be carried over to the following month. Okay, and once you've deferred your 35% for these 4 months of April, May, June, and July, then of course you need to be paying that back to SARS. Now it's for the payroll of April, May, June, and July. Okay, so even in the payment on the 7th of August, you would have paid 65%. That extra 35%, you add all of those 35% deferrals together, divide that by 6, and then pay that back over the 6 months from September onwards. Now, they do say that after the 7th of August, SARS will determine the 6 equal payments. So they will actually show that on your statement of account. So if you want to be 100% sure that, you know, what you are paying is correct as far as SARS is concerned, SARS has said that you can request a statement of account from the 15th of August onwards so that you know exactly what your 6 monthly installments are, which you then have to add on to your employee tax payments for September, October, November, December, and then January and February in 2021. So it's all very well doing the deferral, but you must remember that it is going to result in these additional amounts becoming payable for that 6-month period from September through to February next year. You don't have to do the deferral. I know many employers are just saying, look, it's fine, I'll just pay the full amount of employees' tax, and that's absolutely fine. You can pay the full amount, but you can defer up to 35% of each month's payment in terms of this deferral relief if you are a qualifying taxpayer, and that includes being fully tax compliant. Okay, so this example just shows the deferral and how you would spread that over 6 months. So let's say your employee's tax withheld is $500,000 per month. So for April, May, June, and July, you would pay 65% to SARS. So let's say the April payroll, which had to be paid to SARS by the 7th of May, you take 65% on 500,000. That gives you 325,000. So you pay that to SARS. You defer 35%, which is 175,000. If it was the same for all 4 months, each month you're deferring 175,000. It means at the end of that period, you have deferred 4 times 175,000, which is 700,000. You then take that amount, divide it by 6, and then you have to pay that back to SARS in the 6 monthly installments from September onwards. So your August payroll, let's say that your employee's tax was again 500,000. You have to pay that whole amount to SARS by the 7th of September, plus your installment of 1/6 of 700,000, which is 116,000. Okay, so it will be these extra amounts that you have to add on to your normal employee's tax payments for the 6-month period through to February 2021. And as long as you make all these payments on time, there'll be no penalties and interest. But if you default on any payment under any of these installments, let's say November, you were supposed to pay 116,666 by the 6th of November. For some reason, you missed that payment, you only make it on the 8th of November, there will be a 10% late payment penalty imposed and interest for the time that it was outstanding. Okay, it'll be a 10% late payment penalty on that particular amount of 116,666, okay? Because that amount is due on the 6th of November. So if you pay that late, it'll be a 10% penalty on that amount that was paid late. All right. Okay, so just be careful of that you are aware that there are these additional amounts that have to be paid further down the line. And I mean, you know, in all reality, is business going to get a lot better? Are you going to have additional cash flow to be able to meet these obligations further down the line? That is something that you're going to have to consider. Okay, so that's the deferral of employees' tax. And I think employers have kind of got the hang of this because they've already had a month and they're going into the 2nd month of doing this now when they do their EMP 201s for the May month payable 7th of June. Now, what we are starting to get very close to is many of the provisional tax payments that are coming up, especially if you've got December year ends, you're going to be doing your first provisional tax payment at the end of June, or perhaps you've got a June year end and you're doing your second provisional payment at the end of June. Now, looking at the deferral of provisional tax payments, remember that only qualifying taxpayers are eligible for the deferral on provisional tax. So to be the qualifying taxpayer, your gross income, right, for the year of assessment ending between April 2020 and March 2021 must not exceed 100 million rand, and you can't be deriving more than 20% of income in the form of investment income or remuneration from an employer. And furthermore, you must be tax compliant. All right, so if you're a qualifying taxpayer and you're eligible for the provisional tax relief, then the way that it works is that if you have a first provisional tax payment, which is due between April 2020 and September 2020, all right, so if you've got your first provisional tax payment due, let's say, at the end of April, because you've got a September year end. So first provisional payment, end of April 2020, second provisional payment at the end of September. So the key thing is on the first provisional payment, normally you would do the whole calculation, taking into account your estimated taxable income. We've got those issues around, can you use the basic amount? Do you have to add on the percentage to the basic amount? So you would go through all of those normal rules in terms of working out what is my estimated taxable income for the year. And then what you would normally do is you'd multiply that by your tax rate. If it's an individual, look it up on the tax tables, but we're assuming you're talking about companies here if we're doing a first provisional at the end of April. So you would, let's say your estimated taxable income for the year was 10 million rand. Tax on that would be 28%, 280,000. Then normally what you would do for your first provisional is you would multiply that by 50%, right? But the relief that is given here is that you actually only have to pay 15%. So if you worked out that your normal tax liability for the year was 28% on 10 million equals 280,000, then you'd multiply that by 15%. So you wouldn't have to pay 140,000. You would only have to pay 280,000, 42,000, right? Let me just check my calculation. 280,000 times 15% equals 42,000. So that would be the amount that you'd have to pay as your first provisional. So you can see 35% is effectively deferred. Okay. Then in the second provisional payment, which you have to make, let's say you're now making this payment at the end of September. Let's say again that your estimated taxable income was 10 million rand for the year, times tax rate of 28% is 280,000. And you must, by the end of the year of assessment, have paid now 65%. Usually it would be 100% of that 280,000. But now we're saying you only have to have paid 65% by the last day of the year of assessment. So 65% on 280,000 would be 182,000, but you already paid 42,000 in your first provisional. So you just pay the additional amount of 140,000. So that by the last day of the year of assessment, you have paid 65% of the total tax liability for the year. All right. Then that other 35% that is still payable, and of course, this is based on your provisional tax return. You still have to do your final assessment to work out what your final tax liability is. But on my example, if we said my estimated taxable income is 10 million for the year, so by the end of the year of assessment, I must have paid 65% of that, which was 182,000. And so the other amount, the other 35% on the 280,000, that must be paid when you would normally do your third provisional tax payment. So if your year end is the end of September, your third provisional would be 6 months after that, which would be the end of sorry, have I got this right? April, September, yeah. 6 months after the end of September would be your third provisional, and by then you would have to pay the additional 35%. If you're talking about a February year end, you would do your first provisional at the end of August 2020, your second provisional at the end of February 2021, and then the deferred amount of 35% that you haven't yet paid by way of provisional tax, you would have to pay by the end of September because it's 7 months after the February year end. So you'd pay that And of course, that then is obligatory. It's no longer a voluntary payment. Normally, our third provisional is a voluntary payment, but you're obliged to pay this additional amount of 35% that you have deferred. And the due date for payment is the effective date, which is 6 or 7 months after year end. And any amount that is not paid by then, you can expect to have a late payment penalty, and there will also be interest imposed on any amounts that are still outstanding. So this just puts the numbers to what I was saying just now. If you've got a year of assessment ended February 2021 and your estimated taxable income for the year is 10 million, and that was your estimate when you did your first provisional and your second provisional, so your total tax would be 2.8 million. Your first provisional payment, you'd have to pay 15% of that, 420,000. Your second provisional, you must have paid 65% by the last day of the year of assessment, 1820, minus what you paid in the first provisional, 420,000. And so it's the balance of 1.4 million that you'd pay as your second provisional. So at that stage, first and second together, you've paid 65% of 2.8 million. That other 35% of 2.8 million, which is the 980,000, you must pay that by the third provisional date, the effective date. Because you've got a February year end, your effective date is 7 months after year end, end of September. And so that additional amount is due by the end of September. So it's just giving you a bit of a breather in terms of cash flow, but you still have to make that payment. But at least you can defer this 980,000 for that additional 7-month period, and there's no interest or penalties payable as long as you meet these amended deadline dates. All right, so you must pay that 980,000 by the effective date, which in this case will be the 30th of September 2021. As long as you meet that deadline, there will not be any penalties or interest that will be imposed. Okay, all right, so that's the deferral of the provisional tax. Now, of course, how do you declare this on your IRP6 form? So when you fill out the IRP6 form, whether it be the first provisional or the second provisional, you start with your estimated taxable income, right? And that would then drive the tax liability on that estimated taxable income. That'll be on the total amount. So your total estimated tax liability would be shown as per normal. If it's for the first provisional, you then multiply that by 15%. If it's for the second provisional, you multiply that normal tax liability by 65%. And if it's the second provisional, you would then subtract whatever tax was paid by way of the first provisional tax payment. Of course, you also subtract if any other tax has been paid by way of employees tax, and you would subtract the Section 6 quart rebate as well. Okay, right. So that is the deferral of the provisional tax payment. There's a similar deferral for micro businesses. If any of you are dealing with micro businesses, they also have a type of interim payment 6 months into the year, another payment on the last day of the year of assessment. And again, we see that we have a similar deferral of 35%. So normally you'd have to pay half your total liability 6 months into the year. Now you only have to pay 15%. And then you pay 65% by the last day of the year of assessment, and then the balance will be payable on assessment. Okay, so similarly for micro businesses, to be a qualifying micro business, you must just be a micro business as defined in the 6th schedule. So you must be registered as a micro business, and you must be tax compliant, as we spoke about earlier. Then additional deferrals that were introduced in the revised draft bill is a deferral on excise tax payments. And this links, of course, we all know that there's no alcohol or cigarettes have been permitted to be sold during the period of the lockdowns from the 26th of March right up until the end of May. Excise tax, the so-called sin tax on alcohol and cigarettes, becomes payable by the manufacturers as and when the items are manufactured. So it could be that these items had been manufactured, there was an excise tax payable, but of course the manufacturers have not been able to sell any of these products, and so they obviously have quite a cash flow crunch. So SARS has given them a 90-day deferral on the excise duty payments that would have been due in May and June 2020. All right, so push that out by 90 days. And then similarly on carbon tax, we see that there's also a deferral. in terms of the new Carbon Tax Act, the first filing should have been done on the 31st of July with the necessary payment, but that has also been pushed out through to the end of October. All right, so also pretty much 90 days or 3 months, that's been pushed out from July to the end of October. Okay, so those are the deferral arrangements that are on offer, and those are what we could perhaps call the automatic deferral arrangements. If you qualify as a qualifying taxpayer, tax compliant, and so on, you're eligible for the deferral arrangements as I have described, which is pretty much that 35% carried over and then repaid at a later date. But remember that that's only for qualifying taxpayers. So you might have some businesses with gross income above 100 million for the year. They would not qualify for those automatic deferral arrangements, but SARS has made it clear that they can still apply for deferral arrangements through the large business centre. And even other taxpayers, gross income below 100 million, but perhaps you don't qualify for the automatic deferral arrangements. Maybe you're an investment company, you get more than 20% of your gross income by way of investment income, for example. It is possible to also apply to SARS, but those are done on a case-by-case basis, that you actually have to apply for the deferral of payments without penalties being incurred. Okay, then there's also, in terms of the Tax Administration Act, there is a permanent provision to make payment arrangements. So this is where you can actually apply to SARS for installment payment arrangements. You might have remembered this earlier when I was talking about being tax compliant. I said that you must not have any outstanding tax debt other than debt that has been covered by an installment payment arrangement with SARS. So it is possible just in the ordinary course of events for a taxpayer, if they can foresee that they're going to have difficulty meeting their tax obligation. Let's say, for example, they have an assessment which says there's tax payable of X amount, and that must be paid by the end of May. And the taxpayer can see, as we stand here now, what's today, the 28th of May, that this is not going to be possible. We don't have the cash to pay this tax liability. Then it's important to approach SARS for an installment payment agreement. All right, so you'd actually have to, in writing, apply to SARS for this payment arrangement. In terms of the Tax Administration Act, SARS has to take into account these criteria when they decide whether they're going to agree to an installment payment agreement. And so they look at whether the taxpayer is suffering from a deficiency of assets or liquidity, but that's reasonably certain to be remedied in the future. All right, if there's no hope of recovering this debt, then what SARS is actually looking at then is more of a compromise. But they're not going to compromise debt immediately. That would only happen after a period of time. But they do need to ensure, if they're going to enter into an installment payment arrangement with the taxpayer, they must be sure that there's some hope of recovering these amounts in the future. So they also have to check to see that the taxpayer anticipates income or other receipts which can be used to satisfy the tax debt. SARS also has to ensure, this is in terms of managing their debtors, right, that there's prospects of immediate collection are poor, but they're likely to improve in the future. And also, if collection activity would be harsh in the particular case, if SARS insists that you have to pay this amount now, and what's going to happen is it's going to put the survival of the business in jeopardy and cause the employees to all be made redundant and so on, that they'd have to all be retrenched, that would be particularly harsh. So it would be in the interest of SARS to rather enter into an installment payment agreement so that the business can survive and realize additional income in the future. And then they also have to consider whether the taxpayer should provide security. So sometimes SARS does require security when they enter into these installment payment agreements. All right, so apart from the deferral arrangements, there's also the opportunity, and this is, as I say, a permanent feature of the Tax Administration Act, that you can actually apply to SARS for an installment payment arrangement. Even if you are eligible for the, let's say, the 35% deferral of PAYE or provisional tax, it might be that even with that 35% deferral, you are still just not able to meet your obligations to pay this tax across to SARS. then you can still apply for the installment payment agreements. So those deferral arrangements are kind of automatic deferral arrangements. If you need to make other arrangements for your particular case, then you would apply specifically for those installment payment arrangements to SARS. All right. Then another aspect that's come through in the tax relief is considering this lockdown period. And initially the lockdown period, of course, was from the 26th of March to the 30th of April. Now the lockdown period is going all the way through pretty much to the end of May. Then indications are that from the 1st of June, we will move to level 3. Now, in terms of the actual national lockdown, those days would not be counted for certain tax administrative processes. Be careful, this is not saying that you can submit your tax returns late, all right? It doesn't give you relief in terms of submission dates of tax returns, but it does give that period of time where those days are not counted in terms of, for example, with the dispute resolution process. Normally the rule is that you have to submit an objection. If you want to object to an assessment, you have to submit that objection within 30 days from the date of the assessment. Now, if your assessment was issued at the end of February and you're counting 30 days, remember we're counting 30 business days. So you would count however many business days there were in March, only up to the 26th of March. And then the lockdown started from midnight on the 26th of March. Let me just check that date. Yeah, that was the Thursday night. So midnight on the Thursday night. So from Friday the 27th, actually, through to the end of April, that was during that initial lockdown period, those days are not counted. So if you were counting your 30 business days from, let's say, your assessment issued at the end of February, then in March you would have 5, 10, 15, and 4 is 19 days in March. And then you wouldn't count the days from the 27th of March to the end of April. So then you would count another 11 days in May. And remember, we're not counting public holidays. So that would take you through to pretty much the 18th or 19th of May. All right. So if you're working out the number of days in order to submit the objection by due date, you don't count these days during the national lockdown. Now, of course, whether they're going to change those lockdown days. I'm just having a look at the revised draft bill. In the revised draft bill, they still talk about the lockdown as being from midnight on the 26th of March to midnight on the 30th of April. So it's just still those days that you don't count in terms of the, say, the dispute resolution process. They've also extended that you don't count these days if there's deadlines on submission of request for remission for penalties, interest, and so on as well. And if SARS is given a notice of a certain number of days for interviews and so on, again, you don't count the days during this lockdown period. So it's treated similarly to the days over the December, January holiday time, the Christmas break, where you don't count those days from the 16th of December to the 4th of January, also are not counted for the purposes of this time period. But as I say, be careful. It does not affect the deadlines for submitting returns and making payments. So if you have to submit any kind of return during that period, you have to submit it during that period, like EMP 201s, VAT returns, even tax returns and so on that might have been due. Okay, so it's just with these administrative processes, and especially, as I say, it's particularly relevant with the dispute resolution process that you don't count the days during the national lockdown period. Okay, right, so that's in terms of that COVID-19 relief, and then we move on to specific relief affecting your so-called COVID-19 organizations. Now, initially they referred to these as COVID-19 disaster relief trusts, but now they've extended it beyond just trusts. They now talk about disaster relief organizations. So when we talk about a COVID-19 disaster relief organization, what it means is any non-profit company as defined in the Companies Act, an NPC, or any trust or associations of persons that has been incorporated, formed, or established in the Republic that carries on activities for the purposes of disaster relief in respect of the COVID-19 pandemic. declared a national disaster on the 15th of March, etc. So this can be any kind of charity, trust, association, or persons that might already have been in existence, okay? But they are specifically carrying on activities to provide disaster relief. We see a lot of feeding schemes that are operating, places of safety, places of shelter, etc. So these could all be regarded as COVID-19 disaster relief organizations. Now, pretty much for existing charities, it's not really going to make too much difference because hopefully those existing charities already have their PBO status and their Section 18A status. But if you have a new organization that has been set up, like these new trusts that have been formed with these massive donations from the likes of Patrice Motsepe and Kobus Becker and so on. So those kinds of trusts would come into this definition. And what this is doing is it's basically saying these new organizations that have been set up to provide disaster relief will be given PBO status over the period of the COVID-19 relief. So interim, fast-tracking recognition as PBOs with Section 18A status. Then it also provides a definition of the Solidarity Fund. And that is very specific. It means very specifically the Solidarity Response Fund, registered and with the specific registration number. So this is the one that was set up by government at the start of the COVID crisis, and it's being managed. I think the chairman is Adrian Enthoven, and they have secured huge donations to the Solidarity Fund, and they're using those donations to fund various issues around managing the COVID-19 crisis, like providing personal protective gear and so on to health workers and many other things that they are actually doing. All right, so the key thing is that we have these types of COVID-19 organizations that are recognized. Then we have a look at what does this actually mean? Well, if you're a COVID-19 disaster relief organization, sorry, I haven't changed the word trust there, it should read organization, it's deemed to be a PBO recognized by SARS as long as it's carrying on public benefit activities as listed in Part 1 of the 9th schedule. Okay, so it's recognized as a PBO, tax exempt status, deemed to be granted basically up until the end of July. So it is just giving a bit of time that these trusts have the certainty that they are treated as tax exempt with PBO status for that period. If they want ongoing tax relief status, they would then thereafter have to apply to SARS for PBO status. All right. Now, the other thing is people who are donating to COVID-19 organizations will get tax deductions under Section 18A of the Income Tax Act. Of course, when you eventually submit your tax return at the end of the year, pretty sure SARS is going to be asking for 18A certificates. But the key thing is that you can get the tax deductions for any bona fide donation made by a taxpayer in cash or property in kind, which was either paid or transferred to a COVID-19 disaster relief organization between April and July 2020. So those donations will be recognized under Section 18A. And that limitation is still there of 10% of the taxpayer's taxable income before taking into account any 18A deduction or any 6-quat deduction, if you're claiming a 6-quat deduction. So we do still have the 10% limit, but we do have the certainty that you will get the 18A deduction for any of these donations. But then we have a specific concession that is given for donations to the Solidarity Fund. And this is the enhanced 18A deduction. And the enhanced 18A deduction, instead of just the 10% limit that applies on the other donations and on your normal Section 18A donations, we have a 10% on taxable income. But if it's a donation to the Solidarity Fund, you will get a deduction of up to 20% of the taxpayer's taxable income. But notice that this additional amount, the limitation of 20%, only applies to donations to the Solidarity Fund. Okay. And this will be for years of assessment ending between April 2020 and March 21. And then there's also a concession that is made in terms of the employer taking these donations into account when working out employees' tax. So we already have a provision in the 4th schedule that allows employers to take certain deductions into account, like your contributions to retirement funds, subject to the limitations of Section 11F. But In addition to that, the employer can take into account donations that are made through the payroll, and the normal limitation is 5% of remuneration. That's remuneration, gross remuneration minus your 11F deductions for your retirement contributions. But if we are dealing with donations to the Solidarity Fund, then that donation limit increases from 5% all the way up to 33% of remuneration. So it can be 33% of remuneration over 3 months. So effectively, a person can donate the equivalent of a full month's salary to the Solidarity Fund and get the tax relief. But notice, you only get the tax relief 1/3 per month for the 3 months of April, May, and June, effectively. Or you can take 1/6 of your remuneration over a 6-month period, again, giving you effectively 1 month's remuneration that you can donate to the Solidarity Fund that's spread over 6 months from April through to September. Okay, so that's only on donations to the Solidarity Fund. Other donations to your other 18A institutions, if you're doing that through the payroll, you are limited to 5% of remuneration. Okay, I see there is a question that's come through here. Let me just read it. Payment deferral. We applied to the designated SARS mailbox for a VAT payment deferral, provided all the documents. They responded asking more questions, which we answered, and asking that we submit the relevant VAT return, which we did. That payment is due tomorrow, end of May, and we've not received an answer from SARS. Oh, goodness, whether they will allow our deferral request. That is very tricky because, if you have applied for the deferral, you need to have clarity from SARS as to whether they've allowed it. If you're not able to pay it, and worst case scenario, SARS declines the deferral request, then you're going to end up with a situation that you've got an outstanding liability. And yes, sure, you're going to have the 10% late payment penalty. Possibly you could get that waived. But the other thing is that you could then be showing up as being not tax compliant. So if you were trying to make use of any of the other deferral arrangements, it's going to jeopardize that. So it's quite difficult. I think you should maybe try and get onto the phone to the call center and really try and follow that up today to try and get an answer to SARS so that by tomorrow you do have some certainty. Otherwise, it really does leave you in a very difficult situation without the confirmation from SARS. I mean, I would like to think that they would see your bona fides in the fact that you have applied for the deferral. But the reality is that if they haven't granted the deferral and the due date for payment passes, then that particular taxpayer is going to be showing up as being non-compliant, which does have other effects. Okay, yeah, quite a tricky one. Oh, sorry, I don't know why I've put coffee time here because we shouldn't be at coffee time just yet. What is the time? No, we've still got another couple of minutes to go. So we'll defer our coffee time just for a little bit, if you don't mind. I think don't worry, I will give you a coffee break at 5 to 11, but let's just carry on for now. Okay, because we're talking about COVID-19 organizations. So in terms of these COVID organizations, one of the other forms of relief, especially for small businesses, has been where these COVID-19 organizations provide financing loans to the small business. But the way that works is that they effectively pay amounts directly to the employees of these small businesses. Now, the key thing is that these distributions that are made from the COVID-19 organizations directly to the employees of the businesses, or perhaps through the business, but for the benefit of the employees, there's no PAYE that has to be withheld on these particular distributions. Okay, so it's an amount that comes through from a COVID-19 disaster relief organization, goes through to the employees, and effectively it goes through without withholding tax. But be very careful, this is not the same as a UIF payment. A UIF payment is exempt from tax. These payments are not exempt from tax per se, but the employer doesn't have to work out the PAYE. It's just for a practical purpose because it would be difficult for the employer to do the PAYE calculation. And so just for expedience sake, they've said no PAYE on these distributions, but be very careful that these distributions will still become taxable on assessment. So yeah, quite tricky that you would still end up having the employee having to pay the tax on assessment, but no PAYE is withheld in the interim. Okay, and that's again just for this period from April through to July, and just when you've got these distributions from the COVID-19 organizations. Okay, right, and then the next form of tax relief is in the form of VAT. Any of you who are involved with taxpayers who might be importing essential goods. Now, we know that normally what happens when you import items is that you have to pay VAT on importation of goods. But if it is importation of essential goods as defined, and there's a list of what these essential goods are, you can imagine it'll be things like ventilators, protective clothing, face masks, and things like that. So things that are listed on this list in the government gazette, then you would not have to pay VAT on the importation. But be careful, it doesn't mean to say that if you sell those items, you don't charge VAT. You still have to charge VAT when you sell the items, but this is a specific exemption on the importation VAT that you would otherwise have to pay. All right, and then quite an important one for your smaller vendors who normally do a 2-monthly VAT return, so category A or category B. If they are seeing that they have VAT refunds that they're entitled to, maybe they are net exporters, or maybe they're supplying raw foods or something of that nature, they can actually submit their VAT returns on a monthly basis between April and July, so that you can get your VAT refund paid to you a little bit quicker. Hopefully you do get the refund paid to you. I don't know if any of you have been successful in getting your VAT refunds paid by SARS quite quickly during this period, but that is the intention here, is to say if you're a category A or category B vendor, you can submit on a monthly basis. Of course, there's no point doing that unless you're getting a refund. So it'll be if you are entitled to a VAT refund, so that you can get that VAT paid to you a bit faster. So for example, if you have a category A vendor, so you would have an April-May tax period, you would normally have to submit that VAT return by the end of June. But if you have a VAT refund due on your April tax period, you can then submit that return by tomorrow, okay, 25th of May, and then get your refund for that month. Oh, and you don't have to ask specific permission to submit on a month-by-month basis, right? You can simply go ahead and submit. All right, and then the last bit of COVID relief is expanding access to living annuity funds. So as you know, there's very specific rules about how much of your capital you can draw down by way of an annuity with a living annuity. And so they are providing in this, it's still in the revised draft bill, so it hasn't been legislated yet, but they are bringing through with this bill that you'll be able to increase your access to increase your annuity. So you can increase it or decrease it beyond the current parameters, which are 17.5 or 2.5. So you can go up to 20%, decrease down to 0.5% in terms of the proportion that you receive as annuity income, instead of waiting for the next anniversary date. So you'd be able to do this kind of now if you needed to access more money from your living annuity. Just be careful, of course, because this is going to impact on future annuities. If you draw down more capital now, it's going to leave less for later. But of course, the key thing is that there are many people who are in desperate need of cash flow right now. And it does at least mean that they can access more cash flow through their living annuity fund. Okay, all right. And then the next thing we do to go on to is recent cases. And you can see that there's quite a lot of cases that we're going to be looking at. Yeah, we've been quite fortunate after going through for months and months at one stage with hardly any judgments being handed down. We've now seen quite a few, and these are all cases that have come through the Supreme Court of Appeal. And in fact, listed amongst these are 2 cases that set the benchmark of being the biggest tax cases in South African history. The first one was the Africa Cash and Carry case, over R1 billion worth of tax liability. And then not long after that, that was eclipsed by the Telkom case, which involves almost R4 billion worth of tax liability. So yeah, this, of course, in both of those cases, I'm giving the game away a little bit by telling you that SARS won both of those cases. And so they should have quite a healthy pot of tax collection coming their way. And I'm sure that's going to be in need at this stage when they are going to be battling to meet their tax collection targets. But yeah, some very interesting cases dealing with a lot of different principles. So let's start with this. We may as well get into it, and I'll just talk for about another 5 minutes, and then we'll take a break for tea. So the BMW case, now a really interesting case because we all know that BMW is an international company. It's essentially based in Germany. And this particular taxpayer is BMW South Africa Pty Limited. So it is the South African subsidiary of the international company. And what we see frequently when we are dealing with multinational companies is that they are bringing expatriate employees from elsewhere to come and work, let's say, here in South Africa. And of course, there are a lot of tax issues that go along with expatriate employees. But this focused on a very specific issue, and this was payments to tax consultants to provide certain forms of tax advice. Now, if we had somebody who was working in Germany for BMW and he was approached to come and work out here in South Africa, let's say on a 2 or 3 year contract, while he was working in Germany, his salary was taxed according to the German tax rules. When he comes to work in South Africa, now we have a non-resident who's working in South Africa for a 2 or 3 year period, so more than 183 days, they are going to have to pay South African tax on their salary that they earn in South Africa. Now, it might transpire that the amount of tax that they would have to pay under the South African tax law is more than perhaps what they were paying in Germany. And this person is very unlikely to be willing to come and work in South Africa if they are going to come out with a lower take-home pay than what they would have been earning in Germany. In fact, they probably want a bit of extra to incentivize them to actually come here. And so typically what happens with these multinational companies is that they employ tax consultants to do these tax equalization calculations. And the tax equalization, you basically, let's say for argument's sake, this person was earning 100,000 euros in Germany. And let's say for argument's sake, they were paying 35,000 euros in tax. So 65,000 euros take-home pay. Then you would have to say, right, when they're working in South Africa, what will their tax liability be? What will their take-home pay be? Maybe their take-home pay is going to drop to, let's say, 50,000. So BMW then says, right, what additional amount do I need to pay to this employee? And remember, whatever additional amount we pay is itself going to be subject to tax. So you kind of have to do a grossing up exercise, a bit of a circular calculation, to say what additional amount do I have to pay so that the net effect is that this person's take-home pay is not going to be compromised. So that's the tax equalization calculation that is done. Now, so far, if you said a company is having to pay consultants to do this tax equalization calculation, it could well be that the argument is that is for the benefit of the business, not so much to benefit the individual. But when you look at the agreements between BMW and the 3 firms of tax consultants, in fact, the services that were provided went beyond just doing the tax equalization calculation. It actually covered attending to all the tax obligations of that individual. So they would get the individual registered with SARS, they would submit the tax returns, and if there were any disputes with SARS, they would attend to the disputes. Now, I think you can probably see where this is going, that the company was paying for a service that was benefiting the individuals. Now, BMW argued very strongly, and all the way through to the SCA, they argued that the payment to the tax consultants was only for the benefit of the business of BMW and did not provide a benefit or advantage to the individuals, and therefore did not give rise to a taxable fringe benefit. SARS argued to the contrary. And when BMW took this on appeal to the SCA held in favor of SARS. So it was held that the payments to the tax consultants did indeed constitute a benefit or advantage, and basically gave rise to a taxable fringe benefit. And so there should have been a value that had been determined as the value of that taxable fringe benefit. That should have been added onto the remuneration of the employees for the purposes of working out employees' tax. So at the end of the day, there was a lot of additional employees' tax that was payable. The total amount that BMW had paid to these consultants was just shy of 7 million rand. And so that would have been the cost to the employer of providing those services, obviously split between a number of different employees. Each employee then should have had a taxable fringe benefit, which should have given rise to employees' tax. Notice here that SARS went after the employer to recover that fringe benefit tax. It didn't go after the employee because, remember, it is the employer that has the obligation to pay the correct amount of employees' tax. That is stipulated very clearly in the fourth schedule. And so this was a case against the employer for the outstanding fringe benefits tax. And this would have ended up being a rather expensive exercise for BMW. And of course, going forward, quite clear that any of those payments to the tax consultants to provide the service to their expatriate employees would give rise to a taxable fringe benefit. Okay, so that was the outcome of the BMW case. And I think the takeaway from that you need to be careful about whenever you're dealing with employers, companies, if you're looking at the types of payments they are making for various kinds of services, you need to be careful to ensure that if those services are benefiting the employees in their private capacity, that you are recognizing the fringe benefit on that. And remember that the value of the fringe benefit is the cost to the employer of providing that service. Then you should be recognizing that through the payroll. You should be valuing that fringe benefit, and you should be working out what the employee's tax is on the value of that fringe benefit. It's quite a high risk area. I think there's still a lot of companies that are paying for various kinds of services that do benefit employees, and they're not always recognizing the employee's tax on the related fringe benefit. Yes, there are some nil value provisions. For example, if you have a gym at work and the employees enjoy the gym at the workplace, then that is one of those nil value provisions. But apart from that, if you are providing services, then there should be a fringe benefit that is recognized. I think this also is particularly risky when you look at your owner-managed businesses. And many times there's many costs that are picked up by the company, treated as a tax-deductible expense in the company, but you're not really having a look to see whether actually that gives rise to a taxable fringe benefits in the hands of the director who is employed by that company. All right, so be very careful around the judgment of BMW. They were absolutely adamant, as I say, all the way through to the SCA, that this was not a taxable fringe benefit, but at the end of the day, they lost the case and SARS was successful. Right, okay, so I think that does bring us to the point where we should have our mid-morning tea break. So let's then scroll up to my slide that says coffee time. All right, and we're going to take a 15-minute break, and I'll see you back here just after 10 past 11. Thanks. There are just two questions that had come up. Let's just have a look at those. The one was around claiming TERS benefits. I'm not an expert on TERS benefits, but I'll tell you what I think about this, is that as long as the company is still trading and it's not able to pay the full amount of the salary, then it will be claiming TERS benefits on behalf of the employees. In fact, you might have seen that recently they've even opened this a bit wider, that employees whose employers didn't register them on UIF, the employees can even claim directly. But I would say, yes, they could still claim the TERS benefit because they are still in business, right? They're still trading. It's just that they're not trading at the same level as before. And then the question around primary residence exemption. So primary residence, of course, requires that the person must have actually lived in the property or in the building, in the house, as their primary residence. So does the period of owning the vacant stand before you built counts? That would not add as part of the period of your primary residence. So before you have the building, before you have the house, you only had the vacant stand, that would not be a primary residence. So it would only be a primary residence from the time that the house had been built and you actually moved into the house. So you wouldn't count that period beforehand. In fact, yeah, it makes quite an interesting calculation when you eventually sell that house, is that you'd basically, the period of the primary residence would be while you were living in the house, not while it was a vacant stand. Okay, I hope that does help you. Oh, I see I've gone back and lost my place, but I'll get there again. All right, so we had spoken about the BMW case. And then the next case that we're going to talk about, as I say, we're just going through these. They're kind of in chronological order in terms of the date of the judgment. All right, so this next one is Atlas Copco. Now, you might remember that previously, I think in our last year's tax update, we spoke about the Volkswagen case, and that dealt with the valuation of trading stock. Volkswagen had valued their trading stock, and they were using the international accounting standards, and they were using the international practice for Volkswagen, again, being a multinational company. And they had valued their stock using the accounting principles, and the court said you can't use that. You've got to apply the principles in the Income Tax Act. Now, Atlas Copco, again, we see a similar thing happening, where we're talking again about the valuation of closing stock. Just a reminder that the valuation of closing stock in terms of Section 22(1)(a), it's going to be the cost of your closing stock minus any amount of a write-down that reflects a loss in value due to damage, deterioration, change in fashion, or some similar circumstance. So it's very specific in terms of what write-downs you can actually claim. Now, in the case of Atlas Copco, again, they had applied their global accounting policy. Atlas Copco deals with machinery, and they carried a lot of stock for repairs to various types of machinery. The idea being that if a client had to carry out a repair, they needed to make sure that the stock item was available. So they carried very high levels of stock. At the end of the year, they had an accounting policy that said any items of stock that had been on hand for longer than a certain period, let's say longer than a year, were immediately written down for accounting purposes, a type of an obsolescence provision, by 50%. And they used that same accounting valuation for their income tax valuation. So again, the same question, can we use the accounting valuation? And you'll see that SARS took this case on appeal, and it was found in favor of SARS that, in fact, you cannot use your accounting valuation. We know that now from Volkswagen, and this just confirms the issue that you can't use your accounting policy as a basis for writing down trading stock. You have to use the income tax principles as set out in the Income Tax Act, which, as I say, is your cost of trading stock minus any amount that is reasonable, reflecting a loss of value due to damage, obsolescence, change of fashion, and so on. And remember, the other thing is, and this came out strongly in the Volkswagen case, is that any damage must have occurred before the end of the year of assessment. So it looks back, it looks historically. And it takes into account any loss in value that has happened before the end of the year of assessment. And then you take that into account when you are valuing your closing stock. And so just finally, the point is that the judgment demonstrates the burden that rests with a taxpayer to prove a diminution in the market value of trading stock. And this goes back to the age-old burden of proof. The onus is on the taxpayer, right, to prove these things. And so you must be ready to discharge the burden of proof. And in this case, unfortunately, the taxpayer was not successful. Okay, then the next case is the big one. Well, it was the big one before Telkom came along. But the Africa cash and carry case, really interesting just in terms of the sheer magnitude of the amount involved. And Africa cash and carry, we know, is a huge retail operation, right? And SARS had conducted an audit. In fact, it's quite interesting that when you read the judgment, it makes it clear that SARS had been auditing another similar taxpayer called Jumbo Cash and Carry. And while they were auditing this other Jumbo Cash and Carry, they discovered that there was a glitch. The point of sale system that was being used had a facility where you could do a manual override. And in the other case, the taxpayer had actually done that and they had employed the manual override, resulting in an understatement of sales. And so SARS then, having been successful in that case, they looked around to see which are the other retailers that have a similar software system, and their eyes set on Africa Cash and Carry. They then went in and audited Africa Cash and Carry, looked at the software system. Lo and behold, the same point of sale system was used, and there was the same manual override facility. And in fact, the override facility had been employed. So you could go into the coding of the software and basically put in this kind of override so that it would not record all of the sales. All right, so basically there was an understatement of turnover. But of course, the understatement of turnover, yes, is going to impact on the VAT. And it also impacts on the income tax. But just that there's how do you know how much has been understated, and how do you know what the impact on the actual taxable income is? So the way that SARS went about this is that they did a review over a period of time, and they worked out what the kind of normal gross profit percentage would be for the taxpayer. And then they used that gross profit percentage to work back to say, if this is the amount of stock on hand, this is the cost of sales, what would the sales have been? And they worked out that there was a huge, obviously, understatement of sales. In fact, what they worked out is that your underdeclared sales, they did this over a period from 2003 to 2009, and the underdeclared sales kind of went from 35 million, 71 million, 86 million, all the way through to, in 2009, 145 million in 1 year. All right, so if you worked out the income tax on that, in that year of 2009 alone, the income tax understated was 42 million rand, and then they also applied additional tax at 200%. And then they did a similar exercise for VAT, and they worked out how much VAT had been understated by, and they worked out, for example, and again, they did it for every year from 2003 to 2009. In 2009 alone, they said the output tax had been underdeclared to the tune of 20 million rand, and plus additional tax at 200%. So then they raised their assessments. There was obviously some discussion with the taxpayer, and that went through a dispute. It went through to the tax court. At that point, SARS acknowledged that their gross profit percentage number that they were using was slightly out. It wasn't huge, but it was slightly out. And as a result of that, they then revised their gross profit percentage and re-ran the calculations. I mean, it still ended up with the taxpayer incurring a massive amount of liability to SARS. In fact, the total liabilities on income tax alone was around a few hundred million. And then you had the VAT, also a couple of 100 million, plus penalties added up to this figure of just over 1 billion rand. But the taxpayer was challenging whether SARS could alter the assessment through the tax court, because this is basically what had happened, is that the tax court had queried the gross profit percentage, SARS then said, okay, yeah, they'll change the gross profit percentage, and they issued a revised assessment. So the taxpayer was arguing that that revised assessment was invalid, and they were seeking to have the assessment struck down. But basically, at the end of the day, it was held that actually the tax court had not changed the basis of assessment. The methodology was still the same. It was just that the actual gross profit percentage that they used in the calculation was slightly different, and they changed it actually to the taxpayer's favor, that they came out with a slightly lower liability at the end of the day. And so the SCA concluded that the assessment was valid. And notice here, they appealed, they dismissed the appeal of the taxpayer with costs, as if it wasn't bad enough having this total tax liability of some billion rand that they had to pay. They then also had to pay the legal costs of the SARS team. So a really rather dismal day in court for the taxpayer. And I think the key thing there is, of course, when you look at this and you think, well, just think if you were the auditor of this company, how might you have picked up that the sales had been understated to this extent? And I think it does, of course, raise a bit of a red flag in terms of ensuring. I know that the auditor's job is not necessarily to find fraud, but of course you do need to make sure that you don't end up with egg on your face if the taxpayer subsequently is found to have understated their sales to this extent. So it does raise questions around the audit process. How would you audit this kind of point of sale system to perhaps have picked up that there had been this understatement of sales? Yeah. So a massive tax case, and you can see the judgment was handed down in November 2019. Whether SARS has since recovered this cash, we don't know, but certainly this amount was then owing to SARS with the penalties and interest. Okay, so just interesting in terms of the sheer size of it. Then the next case we look at is Clicks Retailers. So SARS versus Clicks Retailers. You see here that SARS took this on appeal to the SCA. And this involved the taxpayer, Clicks, claiming a Section 24C allowance. Now, let's just refresh our memories on this 24C allowance, because it seems to pop up in quite a few cases. We saw one last year involving Section 24C with the food business, where the person ran the kind of Spur franchises and they were claiming a Section 24C allowance on future expenditure. And here we see Clicks claiming a Section 24C allowance. Now, the Section 24C allowance, as the name indicates there, is an allowance for future expenditure. And it is granted where a person, a taxpayer, receives an amount that comes into gross income, because we taxed on the earlier of receipt or accrual. And so we have an amount that is received by the taxpayer, therefore comes into the gross income for that year of assessment. But that amount will be utilized, the Act says, in whole or in part to finance future expenditure, which will be incurred by the taxpayer in the performance of the taxpayer's obligations under that contract. All right, so you're receiving an amount up front, but you know that there's a certain portion of that amount that is going to be incurred in future expenditure in order to meet the obligations under that contract. And so we often see Section 24C in the context of, let's say, a construction contract, where you pay an amount up front, and then the contractor uses that money to buy materials and so on, and to do the construction. So to tax the full amount of the receipt up front would create a bit of an onerous tax situation, because you have a big tax liability up front, then you get the tax deductions later on in terms of the expenditure that is incurred. So it's recognizing that part of that upfront payment is going to be incurred in future expenditure. But the key thing is that it's looking at the contract, the same contract. If you're receiving the amount up front and under the same contract, you've got future expenditure, then you would be looking at the Section 24C allowance. Now, in terms of Clicks, we are talking about their loyalty card program. And as it applied at the time, because this is obviously looking back a few years, if you might remember the old way that these Clicks points used to work, is that you would present your Clicks card when you went shopping. It would be swiped, and then you would receive in the post, back in the day when the postal system used to work quite well, you would receive literally your paper vouchers indicating the discount that you could claim on your next purchase at Clicks. And then you would take those paper vouchers. Next time you went shopping at Clicks, you would present those vouchers as a customer, and you would then get a discount, some kind of discount on that subsequent purchase. Of course, now it's slightly different because all the points are loaded on the card and it's all done in an automated fashion. But at that stage, it was a case of you have the sale contract. Well, first of all, you have the contract where the person applies for a Clicks card, okay? Then you have the sale contract when the person actually makes the initial purchase at Clicks. Clicks makes the sale to the customer. The customer gets their vouchers later on, and then they come back a month or two later. They make another purchase from Clicks and they present the vouchers for the discount. Now, Clicks was saying that out of every sale that they have, effectively, they have this future expenditure because the customer is going to come back, present their voucher, claim the points, and get the discount on the subsequent purchase. And so they were claiming the allowance for future expenditure on that basis. But the question was whether this was under the same contract. If you look at the sale contract, the initial sale contract, is that the same contract that gives rise to the future expenditure? And in fact, the court came to the conclusion that actually there were a number of different contracts here. You had the contract for the card, you had the contract for the sale, you had the subsequent contract for the next sale that took place, and there was a separate contract when the person presented their voucher and claimed their points as a discount against that subsequent sale. And so it was held that actually the future expenditure was incurred under a different contract than the initial sale contract. Now, remember, this was the similar argument, I should say, that we had with the Big G Restaurants case, which was the one with that owned the Spur restaurants. There they had this initial sale, selling items to a customer, hamburgers, Cokes, etc. And they were arguing that for every rand that they got in from those sales, they would have to incur future expenditure in meeting their obligations under the franchise contract. And they were not allowed to claim the Section 24C allowance because it was not the same contract. And we see the same thing here. It's not under the same contract, and therefore Clicks retailers was not allowed to claim the Section 24C allowance. So SARS appeal was upheld. Okay. Oh, you want to know what the software system was? I don't know. I don't know exactly what it was called. You can read the judgment. I'm not sure they actually tell you in the judgment what software it was actually. But yeah, it's whatever software was being used or maybe is currently even being used by these large cash retailers. Okay, then the next case is also an interesting one, especially in the current environment with the COVID pandemic. This company, Medtronic International, was actually in the business of supplying medical items, including things like ventilators and so on. But of course, these particular facts took place way before we knew anything about the COVID virus. But they do provide, in fact, there's a very big international company which happens to operate in South Africa as well, providing this medically related equipment. However, the sad story was that this taxpayer, Medtronic, South Africa, was the victim of fraud perpetuated by a bookkeeper. And this was no small fraud because the amount of the fraud was to the tune of 460 million rand. Wow. Okay, that's quite a significant amount. And because what had been happening is that this bookkeeper had been diverting money into another account. And so the outworking of the fraud resulted in the taxpayer actually becoming non-compliant with SARS, because it turned out that they had not declared all of their sales to SARS on their VAT returns and so on. And so the taxpayer then applied under the voluntary disclosure program to rectify their tax affairs. So, I mean, what a mess they had to sort out. Never mind the fraud, but they also had to then sort out all of their tax compliance issues. So they applied for the voluntary disclosure program. And it tells us in the judgment that they entered into a written voluntary disclosure agreement with SARS in June 2018. Now, that's quite important to bear that in mind, that they had entered into a voluntary disclosure agreement with SARS. And it revolved around this issue of VAT, that there had been VAT outstanding. And so they made use of the voluntary disclosure program to rectify their affairs. But then after entering into that agreement, the applicant, the taxpayer, then applied to SARS to have a remission of interest under Section 39(7) of the VAT Act, read together with Interpretation Note number 61, which deals with the remission of interest on value-added tax. Now, the thing is that they had already entered into a voluntary disclosure agreement in June 18. Then they applied for this waiver of the interest after that date, and SARS turned down the application to waive the interest, and the taxpayer then raised an objection against SARS' decision in December 2018. That's when things started getting quite messy, because then SARS refused the objection, they refused the request for remission of the interest, but SARS never really said specifically why they refused to remit the interest. The applicant then launched a review proceedings under the Promotion of Administrative Justice Act, and they sought the help of the court to force SARS to provide some information, and they argued that SARS had not provided all the information that they needed. And then it seems there was a huge squabble between the taxpayer and SARS about whether SARS had provided the necessary information that the taxpayer had asked for. And so it all then became a long technical argument around this issue of whether SARS had provided the necessary information. And then right towards the end of the judgment, it actually transpires that SARS says, they say, well, look, we could not have waived the interest in any event because the taxpayer had already entered into a voluntary disclosure agreement with SARS in June 2018. So all this argument went on for months and months after, where the taxpayer was applying to have the interest remitted, and SARS said no, but they didn't really give the reason why. And then the taxpayer was using legal force, as it were, to force SARS to submit certain documents. But eventually what came out is that actually there was no basis on which SARS could have remitted the interest, because the agreement, the voluntary disclosure agreement that had been signed between SARS and the taxpayer in June 18 kind of overshadowed all of these other aspects, because now the debt had taken on a different character. And so the VAT debt that was owing, with the capital and the interest, became the subject of that voluntary disclosure agreement. And so the taxpayer could no longer, once they had signed that agreement with SARS, they could no longer make use of the normal remittance rules to try and get interest remitted and so on. So I think it's quite an important one to bear in mind, that if you do go the voluntary disclosure route and you end up signing a voluntary disclosure agreement with SARS, that then overshadows any other course that you might have to get any kind of penalties or interest remitted under any other provision of the Act. So although this judgment seems to argue and focus a lot on whether SARS had provided the right information or not, I think the lesson that comes out of it is very much around the issue of what happens when you sign that voluntary disclosure agreement, that it overshadows any other process that you might otherwise have used to apply for a remittance of penalty or interest. Right. Okay, so that's the Medtronic case. And sorry, I should have shown you all these facts when I was going through it, but the next few slides just showing the facts of the case and explaining about the fact that they had signed this voluntary disclosure agreement. Okay, all right, so the dispute looked as if it was around providing information, but actually central to it was this voluntary disclosure agreement. And the finding was that SARS was correct in its contention that the documentation sought was irrelevant, okay, because they could not have remitted the interest in any event because that had been overtaken by the voluntary disclosure agreement. Quite interesting in terms of the finding on costs, because the taxpayer argued that, and in fact, there's a statement in the judgment that SARS perhaps gave the taxpayer more of a runaround than was necessary because they had acted with this mysteriousness of not being clear to the taxpayer about why they couldn't remit the interest. And so when the court was looking at the finding on costs, they made this point: much of the dispute could have been avoided had the respondent, SARS, in its initial letter in November 18. Remember, they signed the voluntary disclosure agreement in June 18. So this letter in November 18, in response to the request for remittance of interest, if they had clearly and unequivocally stated that they were statutorily precluded from even considering the request for the remittance of interest, they could have said that, but they didn't. It was kind of all clouded in mystery. And as a result, SARS was refusing to even consider the merits of the remittance of interest. Instead, SARS, chose to create confusion by stating that the Commissioner cannot accede to the request for the remittance of interest. That the aforesaid created confusion in the mind of the applicant's legal representatives is clear, as the objection noted in December 18 did not deal with whether the Commissioner could or could not consider a request, but rather whether the applicant had benefited financially. But at the end of the day, the order that was handed down by the court was basically that the application under Rule 30A, which was the application for documents and information, was dismissed with costs. Okay, so yeah, at the end of the day, the taxpayer was pretty unsuccessful through all of that. Okay. All right, then the next case I want to look at is Elfdav Construction. As I say, quite a lot of cases here, but all have very interesting principles that we can learn from. This one, the judgment was handed down in February 2020, and this was basically an application under Rule 42 of the Rules of the Court. And basically what had happened is that the taxpayer had taken a matter through the underlying court, the High Court, and there was a judgment that was handed down, and the taxpayer was applying for that judgment to be varied. Now, the judgment that was handed down, the taxpayer wanted it to say that the taxpayer should resubmit their VAT returns without penalties and interest. Because what had happened is that the judgment that they had obtained had basically said that they must resubmit their VAT returns, but it still carried penalties and interest. So let's just have a look at the facts here. So the taxpayer filed this application seeking an order to review and set aside certain VAT assessments for the periods from 2009 to 2013. And they applied that they be ordered to resubmit. And so they did get the order to resubmit, but the order didn't clarify that there would be no penalties and interest. All right. And so the taxpayer wanted to make it quite clear that the penalties and interest would not remain a feature of those VAT assessments. So unfortunately, the underlying court had not addressed the issue of penalties and interest. And so the applicant brought an order asking that that judgment of the underlying court be amended to read that they're ordered to resubmit without incurring penalties and interest in respect of the resubmission, etc. And so this was the application to the court. Now, the court clarified that when you look at Rule 42, what does this actually deal with? It provides that the court may, in addition to other powers it may have, mero muto, or upon the application of any party affected, the court may rescind or vary an order or judgment erroneously sought or erroneously granted, etc. And it goes on to say any party desiring relief under this rule must make application, and the court shall not make any order rescinding or varying any order or judgment unless satisfied that all parties whose interests may be effective have notice of the order proposed. Okay, so in this case, the taxpayer had applied for a variation of an order. They're saying it was erroneously or granted, and they wanted it to be changed. Now, the finding was that because the taxpayer had not raised the issue of penalties and interest in their original application to the High Court, they would not be allowed to vary the order of Chetty. So in other words, the taxpayer themselves never raised the issue of penalties and interest. And so therefore, the order that had been handed down by the court was handed down on the basis of the information that was provided by the taxpayer. And because the taxpayer never raised the issue of penalties and interest, the court found that the order must stand as it was issued and could not be varied. So the taxpayer's application here was dismissed with costs. All right, rather expensive and a bit nasty for the taxpayer that they then still were faced with all of those penalties and interest on their outstanding VAT returns. Okay, so you can see a lot of issues around VAT here. And this next one also dealing with VAT. Very interesting case, this one, Diageo, South Africa versus SARS. Now, I think I did keep it on the next slide. Let me just show you. If you're wondering what kind of business Diageo is in, they are in this business. I had a look at their website, and this is what they tell us on their website, that they are the local distributors of all of these products. We haven't seen these for a while because alcohol's not been allowed to be sold right now, but I'm sure you recognize many of these bottles, Smirnoff, JMB, etc., Tanqueray, gin. This is all alcoholic products that are imported into South Africa. And Diageo are the distributors, right? They import all these products and they distribute them around South Africa. They say they've got 200 brands enjoyed in more than 180 countries, but we're focusing on their South African operation. Okay, so we understand the business they're in. Now, the suppliers of all of these brands are situated outside South Africa. They are non-residents, okay? Diageo is the local distributor. So Diageo, in the course of carrying out their distribution in South Africa, they undertook certain promotional activities on behalf of the distributors. And so this case, and I'm just going to go back now to the main slide, involved the supply of advertising and promotional goods. Now, what Diageo did is they then undertook to provide all of these parties, promotional activities, advertising, and so on, and they would charge the overseas suppliers for this advertising work that they were doing. Fair enough. They're providing a service for a non-resident who is outside South Africa at the time they provide the service. So one could understand that they are treating that as a zero-rated supply. But within that, within the course of doing the advertising and promotion, they were also giving out free drinks, okay, which I suppose happens at many of these promotional activities. And they also charged the overseas suppliers for the cost of these free drinks that they were giving out in the course of the promotion. So what they were charging the overseas suppliers for was a fee for actually doing the advertising and promotion, and they're also charging them for the cost of the alcohol that had been given out. And they had zero-rated the entire supply. And so they treated it all as a zero-rated supply. SARS challenged them on that and said that you had to apply the provisions of Section 815 of the Value Added Tax Act. And Section 815 says this. It says, for the purposes of this act, where a single supply of goods or services, or goods and services, would, if separate considerations have been payable, if it would have been charged with tax partly at the standard rate under 7(1)(a) and partly at the zero rate under Section 11, then each part of the supply must be deemed to be a separate supply. So in this case, Diageo was making a supply for the overseas suppliers of these products. Okay, they were providing advertising and promotional services. They were charging the overseas suppliers for their advertising and promotion services. They had one charge, but actually, if you looked at the supply, there were two components. The one was the service that was provided. The other one was charging for the actual items that had been consumed in the course of providing those services. They had applied the zero rate to the whole transaction. But Section 815, which is a deemed supply provision, says that if you had had separate considerations, would you have had two different tax treatments? So if we had supplied those the drinks and then invoiced for the drinks, would that have been zero rated? And the answer is no, because those drinks were consumed in South Africa. And so that would have been a standard rated supply. The service that was provided for the non-residents while they were outside South Africa, yes, that would be a zero rated supply, but not the supply of the drinks themselves. And so the finding of the court was that actually you did have to apply Section 815, and therefore you have to split the supply. Okay, so you can see what we said here, the supply of promotional goods as a portion of the single advertising and promotion service was by virtue of Section 815 a cognizable supply of goods capable of notional separation. So you could separate the goods from the actual advertising and promotion services that were being supplied. And they went on to say the local supply of promotional goods not exported but consumed in the Republic was accordingly deemed to be a separate supply. Therefore, VAT at the standard rate was justifiably levied on these goods, with the result that the additional assessments were confirmed, because SARS had raised additional assessments where they actually charged VAT at the standard rate on the drinks that were consumed in South Africa, whereas Diageo had applied the zero rate to the whole supply. So in the tax court, it was held that Diageo was liable for the output VAT under Section 815 in respect of that component of the supply that you'd have to treat it separately and subject that component of the supply to VAT at the standard rate. And this is what Diageo appealed against. But at the end of the day, the SCA held in favor of the commissioner. They said the commissioner has correctly submitted that 815 is indeed a deeming provision. They went on to say that it's situated in the Act where it talks about certain supplies of goods or services deemed to be made or not made. And then they quote from Mouton versus Boerland Bank saying, the intention of a deeming provision in laying down a hypothesis is that the hypothesis shall be carried as far as necessary to achieve the legislative purpose, but no further. All right. And then so they basically said the jurisdictional requirements that must be met before the deeming provision can be invoked. First, there must be a single supply, but it must involve two or more types of goods or services, or a combination of goods or services. Then one consideration is payable for that single supply, but the circumstances are such that if the supply of the goods or services had been charged for separately, part of the supply would have been standard rated and part would be zero rated. In this case, the taxpayer treated the whole thing as one supply, zero rated, but Section 815 creates a deeming provision that says it's deemed to be two separate supplies. So even though in terms of the contract it was stipulated as one supply, the deeming provision overrides that. And they went on to say that Section 815 must be interpreted in the context of the provisions of 71A, which is your standard rated supplies, and 112L, which is your zero rating services rendered to a non-resident. And so the goods or services supplied to non-residents who are outside the Republic, so you performing the activities in the Republic, but the non-residents are outside the Republic at the time the services are rendered. All right, so that is zero rated, but the actual provision of the drinks, the supply of the goods relating to this, the total supply, is then subject to VAT at the standard rate. Okay, so it goes on to talk about Section 815. It also, interestingly, they spoke about CSARS versus British Airways. Now, in that case, British Airways, it was a case involving international travel, British Airways traveling internationally, and British Airways recovered from their customers some of the airport taxes and so on that they had to pay in South Africa. And the question was, there's a total amount charged for an airline ticket. It's one amount charged. It's an international flight. Surely the whole thing should be zero rated. But actually, British Airways came out with a slightly different answer because what they were doing is they were recovering certain costs. So part of it was a cost recovery and part of it was a supply that was zero rated. But nonetheless, they did also look at Section 815, and they said the section applies to a single supply of goods and services comprising parts that would each, if they had been supplied separately, have attracted a different rate of tax. In such cases, each part of the single service is deemed to be a separate supply. Although in truth they are not, because the real contract is that it's one supply, but Section 815 intervenes and deems it to be two separate supplies. So just be very careful of this in terms of VAT and zero rating. I think we've seen quite a few tax cases which make it very clear that you must be very careful if you apply the zero rating provisions to make sure that you've met all the requirements to have that supply zero rated. And I guess the warning that is coming through in this case is that even if you've got a single supply in terms of the contract, have a look at that contract. What is it actually providing for? If it's actually got component parts, sometimes dealing with the provision of goods like in this case, and sometimes with services, make sure that there's not a situation where you might have to break that down into the different component parts, where some of it would be subject to tax at the standard rate and some would be taxed at the zero rate. All right, so just be careful, because in this case, Diageo went out and charged the whole lot at the zero rate, and of course they ended up then with a significant additional tax liability that they had to face as a result of the SARS audit. Okay, all right, quite a lot of argument about whether 815 creates a artificial solution, but at the end of the day, the court came to the conclusion that Section 815 did indeed apply, and therefore the taxpayer was liable for the additional tax liability. Okay, so yeah, again, we're not seeing too much success of taxpayers in these court cases, but such is the nature of it. The next case, and I guess we may as well go straight into it. It is heading towards 12 o'clock, 11:51, but let's go into the Telkom case. Very interesting case. As I say, this is now goes down in history as the biggest tax case in South African history. The judgment handed down on the 25th of March, 2020. And this was an appeal directly from the tax court through to the SCA. Telkom took the matter on appeal. There was also a cross appeal that SARS had raised. So there were different aspects in this case. The main focus of the case revolves around Section 24I. Now, Section 24I is the provision in the Income Tax Act that deals with exchange gains and losses. And it applies where you've got exchange items, right? So when we talk about exchange items are defined as things like loans, debt, forward exchange contracts. In essence, you could say financial instruments. And when you've got these exchange items which are in foreign currency, obviously we have to work out the tax effect in South African rands. And so if there's a movement in foreign currency, let's say, for example, on a loan, you issue a loan, you raise a loan at, let's say, $1,000 at the time when the rand dollar exchange rate is perhaps at 12 rand to the dollar, okay? And then after a few years, well, at the end of every year, let's do it at that stage. At the end of every year, you would have to say, what is the current exchange rate at year end? And then translate that loan to rands using the current exchange rate. If you end up with an exchange gain, the whole amount of that exchange gain has to be included in income. If you end up with an exchange loss, you claim the exchange loss as a tax deduction. That's just putting the effect of Section 20I very simply. But the key things with Section 24I is the exchange rates that you use. So typically, you would use the spot rate at the end of the year of assessment. So if your spot rate moved, let's say, from 12 rand to the dollar to 15 rand to the dollar, that movement in the exchange rate is going to create either an exchange gain or loss, depending on what the underlying exchange item is, if it's a debt or a loan, a liability or an asset, etc. Okay, so that movement in the exchange rate, now how do we work out the movement in the exchange rate is by working out the exchange rate on the last day of the year of assessment. And in Section 24I, it tells you what the exchange rate is that you have to use. It talks about the ruling exchange rate, and it talks about the spot rate on the transaction date, on the translation date, which is typically your year end, and then on realization date. Then it does provide that on realization date, your spot rate might be the prevailing market-related rate, which is kind of quoted, in the financial media, etc. But it says here that where the rate prescribed in respect of a debt is the spot rate, and any consideration paid or incurred or received or accrued in respect of the acquisition or disposal of the debt was applied by applying a rate other than the spot rate, then the spot rate is deemed to be that other rate. And this is the provision that Telkom applied. Now, what happened with Telkom, and we'll go through the facts on the next slide here, is that Telkom had acquired certain shares in a Nigerian telecommunication company. Initially, a certain tranche of shares, and then they went in again and bought up the remaining shares, so that they ended up holding 100% of this Nigerian telecommunications company. That company needed funding, and Telkom advanced loans to this Nigerian company amounting to, just look at these numbers, $877 million US. Okay, now those loans had initially been advanced around about 2008, 2009. Then further down the line in 2011, some of the loan had been converted to preference shares, but that still left loans of some $531 million US that were outstanding. Now, if you think about the effect of Section 24I, this is a loan. Telkom is a South African company. They've made a loan in US dollars. So this loan would be an exchange item. And you would normally work out the Section 24I gains and losses by taking the exchange rate at the transaction date, and then again at the end of each year of assessment. And so if your exchange rate was moving, that actually it was, the rand value against the dollar was decreasing, so it's costing more rands to acquire every dollar. As that goes on, it means that this rand value is going to be fluctuating from year to year, and it's going to create exchange losses in this case. All right, so during Telkom's 2012 year of assessment, they then sold their interest in Enco, and they effectively sold the debt. So the debt was sitting at 531 million rand. They sold the debt for a paltry $100 US. Wow. Okay, so talking about losing a lot of money on that transaction. They had been translating this debt from US dollars through to rands, fair enough. But then when they sold the debt for $100 US, they used this proviso around the spot rate, and they then said that they ended up with an exchange loss of 3.9 billion rand, and they claimed that exchange loss as a tax deduction. How did they get that exchange loss? Well, they translated the US dollars of 531 million at the translation rate at the previous year end, and then at the time that they sold this debt, they said, right, we're now using a different rate, which becomes our spot rate, and that's the rate using US dollars of 100, okay, and then translating that to rand. So much of the loss that was incurred there was actually the loss of the loan in US dollars, not so much just the exchange rate variation, but they claimed that whole lot as a foreign exchange loss. SARS disallowed that deduction, and they said, actually, you've got an exchange gain of 425 million rand. So instead of having an exchange loss of 4 billion rand, you've got an exchange gain of 425 million rand. And then they said the loss on the loan from 531 million US dollars down to $100, that is a capital loss on a loan. That is not part of your Section 24I foreign exchange loss. So, I mean, it's quite interesting that Telkom was so adamant that they were entitled to this exchange loss, because I think it's pretty clear that most of that loss related to the US dollar value of the loan. And that's really what the SCA looked at, is that they basically said, well, let's have a look at Section 24I and what is the ruling exchange rate that one can use. And here is what I was saying, is that you look at the spot rate basically on transaction date, translation date, and realization date. And here's the proviso that says where the rate prescribed in respect of a loan or advance, etc., is the spot rate on the transaction date or the date on which the loan is realized, and any consideration paid or payable or receivable, etc., was determined by applying a rate other than the spot rate on transaction date. Such spot rate shall be deemed to be the acquisition rate. So what Telkom was saying was that on that 531 million US dollars, they had a spot rate at the beginning of the year, but then on the transaction date when they actually realized that loan, they were using another rate linked to that $100 as their rate, and therefore they used that as the spot rate. So then claiming that whole difference as an exchange loss. So the resolution of the dispute, the judgment said, was to be found in the interpretation of Section 24I, Can we take into account the whole write-down of the loan, or is 24i only dealing with the exchange gain or loss on the original dollar value of the loan? And at the end of the day, the court found in SAR's favor. Telkom was arguing that that proviso allowed them to use this other variation of a spot rate and applied that to the $100. And they argued quite strongly that they should be able to use that rate, and therefore that gave them an exchange loss of 3.9 billion rand. But the SCA agreed with the tax court and with SARS, and they found that Telkom's arguments had to be rejected because they said Section 24I deals with gains or losses caused by foreign exchange fluctuations, not looking at the underlying loss on the loan itself. The underlying loss on the loan itself is actually a capital loss, all right? And so 24I is not dealing with that. 24I is just dealing with what is the exchange gain or loss on that $531 million loan. They said when the proviso is interpreted in the context of the section as a whole, the use of the word rate means an exchange rate which reflects the value of a particular currency. It's a currency exchange rate, not a discount rate. And that's kind of what Telkom was doing, was treating that as a discount rate, discounting their loan down to $100 and treating that as an exchange loss. They said in order to satisfy the requirement in the proviso that the consideration must be determined by applying the rate, the consideration would have to be the result of a process of calculation which utilized the rate as a factor to produce that result. I find it quite curious that Telkom was so adamant on this issue around actually taking the whole write-down of the loan as an exchange loss. And so the SCA went on to say the only type of rate that would have been able to perform the function was basically looking at that fluctuation in the exchange rate. It was apparent that the consideration for the loan of $100 was agreed by reference only to the perceived value of the loan, and that currency exchange ratios played no role in the determination of the price. The SCA agreed that 24I is not intended to deal with the tax consequences of commercial losses, and that its operation is limited to gains and losses on currency fluctuations, and therefore they dismissed Telkom's appeal with costs. Very expensive day in court for Telkom. Now, Telkom has indicated immediately that they are going to take this matter on appeal to the Constitutional Court, but it remains to be seen what happens with that. Of course, that was the main issue, was this 3.9 billion rand exchange loss that SARS disallowed, and you can see SARS was successful on that one. SARS had also brought a cross appeal, quite interesting in terms of cell phone contracts and in terms of paying commission and so on. So in 2012, Telkom had paid a cash incentive bonus, like a commission, of 178 million rand to Velocity, we'll call it VC, in respect of connecting subscriber contracts relating to special tariff plans. So these connections were made by VC on behalf of Telkom. And so for every contract that was concluded, Telkom paid a certain amount of bonus. And the bonus payment ended up being this total amount of 178 million rand. So Telkom claimed that that whole expense as a deduction in the 2012 year of assessment. They said the expenditure incurred in the production of income, etc., they claimed that as a tax deduction. But SARS applied Section 23H, so they added back a portion of that amount and said you can't deduct it in the current year because you're not getting the benefit of that expenditure during the current year. Let's have a look at Section 23H. It says where any person has during a year of assessment actually incurred expenditure other than on trading stock, which is allowable as a deduction, let's say under Section 11A, in respect of goods or services, all of which will not be supplied or rendered during the year of assessment, or any other benefit, the period to which the expenditure relates extends beyond the year of assessment. And this is really where Telkom came in. They were paying this bonus to get the benefit of the contract, but SARS was arguing that they were not getting the full benefit of the contract by the last day of the year of assessment because much of the benefit was only going to be derived over the 2-year period of the contract, which went beyond the end of the year of assessment. And so in terms of Section 23H, the portion of the expenditure that relates to that benefit that extends beyond the end of the year of assessment should not be allowed as a deduction in the current year. We can actually jump over this slide. That actually should be deferred and extended over the period that you actually enjoy the benefit. Notice that Section 23H, there's some areas where it doesn't apply. If you are going to use up all the goods or services, or you're going to get the whole benefit within 6 months after the end of the year of assessment, or the total amount does not exceed 100,000 Rand, or you've got an unconditional liability to pay in terms of any legislation, or 24K or 24L applies. Now, of course, none of those exemptions applies. The benefit that we're talking about goes beyond 6 months after the end of the year of assessment. It's way more than 100,000 Rand, and it's not imposed by legislation. That would be, for example, if you pay your municipal rates and taxes on an annual basis. You could perhaps say, well, it's imposed by legislation. So was SARS entitled to apply Section 23H to this amount? And in terms of the judgment, they said the inquiry into the benefits derived by Telkom from the expenditure incurred, basically you are getting that benefit over the period of the contract. So SARS argued that Telkom did not incur the cash incentive bonus merely to get the new connection, but they're getting the benefit over the period of the contract. And they only get that benefit when the connection fee turns into fee income, which only happens as the contract unfolds and the subscription fees are paid by the customers. All right, so although Telkom contended that they should have got the full deduction in that particular year because they contended that they got the benefit on signing the contract, and therefore they should get the deduction in that year, there was no extension of the benefit beyond the end of the year of assessment. But unfortunately, the finding was in favor of SARS, okay, that the true benefit was actually over the 24-month period of the contract, and therefore the benefit extended beyond the end of the year of assessment, more than 6 months beyond the end of the year of assessment, and therefore Telkom had to apply Section 23H. They couldn't get the whole deduction in year one. They had to spread it over the period of the contract. So again, just being careful about this, when you are paying amounts, depending, I mean, it could affect many different types of payments. But I guess you always need to be thinking about what is the benefit that we're deriving from this payment. If we're getting the benefit in the current year of assessment, or if you're acquiring goods or services that are all going to be used in the current year of assessment, that's fine. But if there's going to be a deferral where some of those services are only going to be realized later on, or the benefit is only going to be gained later on after the end of the year of assessment, be very careful around whether Section 23H has to apply, which would defer the deduction of some of that expenditure. Okay. All right, so rather a nasty time in court for Telkom. At least what did count in their favor is that there was a huge understatement penalty of 91 million Rand, and that penalty was set aside. So sure, at least a little bit of relief there in terms of the penalty. Okay, so maybe we should just take a 10-minute leg stretch. We're almost at the end, but in fact, I think the next one might be the last case, but I feel bad about going on past the break. So take a 10-minute break, even 7 minutes, and we'll carry on at 12:15, just to stand up and get the blood flowing, and then we'll do the last case. Thanks. Is everybody ready to go into the last session before we finish off? Okay, so the last case that I want to be talking about, I think this is the last one, is the SIP project managers. This is actually not an SCA case, it's a High Court case, but a really interesting judgment being handed down from the High Court of the Gauteng Division, and a very recent judgment handed down on the 30th of April 2020. But it's really important, I think, to cover it because it covers something that I think many taxpayers have to deal with in terms of their interactions with SARS. Talking about Section 179 of the Tax Administration Act, and that is the provision that talks about SARS appointing somebody as an agent for the purposes of recovering an outstanding tax debt. So in this particular case, SARS had appointed the applicant's bank, Standard Bank, as an agent and instructed the bank to pay across funds from the applicant's bank account to settle outstanding tax debt. The taxpayer argued that the necessary notice, the final demand for payment, had not been issued, and so the court also looked at the rules for electronic communication. SARS, of course, says that they have issued it, they put it on the person's e-filing profile, that is sufficient delivery. But in this case, the taxpayer said that the notice had not been placed on the e-filing profile. So at the end of the day, the question was whether SARS had been correct in notifying the account, the bank as notifying, sorry, take a deep breath. They had notified the bank that they had been appointed as agent to pay across these funds from the applicant's bank account. So the taxpayer sought an order to declare that SARS notice was actually null and void and was invalid, that they did not have the right to appoint the bank as an agent, and therefore the amount of money that had been taken out of the applicant's bank account should be paid back to the taxpayer. And it revolved around this issue around whether SARS had followed the proper process before they had actually issued an instruction of appointment of agent to Standard Bank. Now, of course, there is a process that SARS has to follow if there's an outstanding tax debt and SARS is going about trying to recover that debt. And first of all, remember I said right at the beginning of the webinar today that a debt only becomes outstanding once you have passed the due date for payment. SARS can't take steps to recover a debt before you've reached the due date for payment. Now, what happened in this particular case is that SARS had, first of all, issued an assessment on the taxpayer reflecting a refund of 1.6 million. But then SARS undertook an audit. They chose to try and verify the assessment. They asked for certain documents. For some reason, the documents were never furnished. And because the taxpayer had not responded to that request for information, SARS disallowed a whole lot of deductions that had been claimed by the taxpayer. And as a result, they raised an assessment of 1.2 million. So instead of having a refund of 1.6, the taxpayer now supposedly owed SARS 1.2 million. Now, the taxpayer was unaware at this stage that all of this had happened. They did not know that SARS had raised this additional assessment. The assessment had actually been uploaded onto the taxpayer's e-filing profile, but it didn't come to the notice of the taxpayer. They didn't realize it was there. Now, that assessment showed that this amount of 1.2 million should have been paid, due date for payment 30 November. There's a bit of confusion with the dates in the judgment, but this date of 30th of November makes sense, as we'll see as we go along. So this debt was due to be paid. The debt under the revised assessment was due to be paid on the 30th of November. But of course, the taxpayer was unaware that any of this had happened. The first that they knew about it was when the bank was notified by SARS that they had been appointed as an agent, and they had received notification on the 6th of February to pay across an amount of 1.2 million from the bank account across to SARS. At that stage, SARS then notified their accountant, and he obviously got a big fright and had a look at the e-filing profile, and he realized that this additional assessment had been there on the e-filing profile since October 2019. But there was no letter of demand to demand payment of this amount. So there was only the additional assessment showing the liability, but there's no further steps evident on the e-filing profile that SARS had taken to recover that outstanding debt. In particular, no letter of demand on the e-filing profile. Quite clever. The taxpayer took a screenshot of the e-filing profile page to as proof that there was nothing on the e-filing page by way of a letter of demand. Then the taxpayer went about what one would normally do when you disagree with an assessment, lodged the objection, applied for the condonation of the late filing of the objection, because obviously you've gone beyond the 30-day deadline now, and applied for suspension of payment. All right, so those are all the steps that would normally have happened had the taxpayer known that this additional assessment had been raised and posted on the e-filing page. But of course, in the meantime, SARS had already taken this money out of the taxpayer's bank account. So going on, just to get the next page, if we have a look at Section 179, this is the provision in the Tax Administration Act which applies to appointing a third party as an agent to recover a debt. So SARS would raise the IT88 notification that you've been appointed as a third party, whether it's the employer that has to withhold money from a person's salary or wage, or it's a bank that has to pay money across to SARS. But it's very specifically governed. It says a senior SARS official may authorize the issue of this notice to a person who holds or owes or will hold or owe any money, including a pension, salary, wage, or other remuneration for a taxpayer, requiring the person to pay the money to SARS in satisfaction of the outstanding tax debt. Notice it's a senior SARS official who is required to authorize the issue of the notice. Many times you don't really know who it was who authorized, but the law very clearly says it must be a senior SARS official. And then the second paragraph, a person who is unable to comply must advise that senior SARS official for the reasons within the period specified in the notice, and the official may then withdraw or amend. That's if you can't comply. Otherwise, you have to, basically, the person who's been appointed as an agent of SARS has to act in accordance with that instruction. So they have to pay the money in accordance with the notice. And if the person parts with the money contrary to the notice, that person is personally liable for the money. So if it's an employer that's issued with an IT88, it becomes quite an onerous responsibility. You have to comply. Otherwise, you take on personal responsibility. In this case, the bank similarly had to comply, or they became personally liable for the money. SARS may, on request by a person affected by the notice, amend the notice. But of course, that didn't apply in this case because the taxpayer was unaware that all of this was going on. Now, very importantly, let's just have a look at the subsection 5. SARS may only issue this notice after delivery of a final demand for payment. They have to deliver this final demand for payment to the tax debtor, all right? And only once they've issued a final demand for payment, and that must have been issued and delivered at the latest 10 business days before they issue this IT88 notice of appointment of an agent. And that's the key thing in this case is had SARS actually delivered this final demand for payment before they went ahead and issued the notice of appointment of agent. All right, so SARS obviously said yes, they had issued the final demand, but as far as the taxpayer was concerned, there was nothing that was not on their e-filing profile, and so they argued that no final demand had been delivered prior to the issue of the notice to Standard Bank. And in any event, they said if SARS is arguing that this letter, because SARS produced a letter as part of their evidence, a letter dated the 7th of November, but they said even if you find that that was a letter of demand that was delivered, that date of the 7th of November is before the due date for payment. Remember, the due date for payment according to the assessment was the end of November. So they said you can't issue a final demand for payment before the debt has even become due. So if SARS was going to argue that that was the final letter of demand, it was null and void because it was issued before the debt had actually become due. The court also looked at the rules for electronic communication. Rule 3.3 talks about if there's an acknowledgement of receipt for electronic communication, if you don't receive an acknowledgement of receipt, then your communication is regarded as not delivered, except for an electronic filing transaction. In the case of e-filing, a simple delivery onto the applicant's e-filing profile is sufficient for something to have been delivered. And this is what I think makes everyone very nervous, is because you don't always know when SARS has posted a letter or some kind of correspondence onto your e-filing profile. And in terms of the rules for electronic communication, a simple delivery onto your e-filing profile is sufficient to constitute a valid delivery. But the point of the matter in this particular case was that in fact, that final demand had not been posted on the taxpayer's e-filing profile. SARS argued that they had this demand letter of the 7th of November, followed by a reminder and a further letter. But in fact, none of those letters were sent to the taxpayer or loaded onto the e-filing profile. Quite strange that SARS had created these letters, but they'd done nothing with the letters. So none of them had actually been posted onto the e-filing profile, and the taxpayer was able to prove that with the screenshot that they had taken of the e-filing profile. So the finding was that actually no letter of demand had been delivered to the taxpayer. And in any event, the letter dated the 7th of November that SARS produced was dated before the due date for payment, and therefore it was null and void. And so at the end of the day, here's at least a case where the taxpayer was successful, is that the third-party notice that SARS said they had issued was declared to be null and void, and therefore SARS was ordered to repay the 1.2 million rand back to the taxpayer together with interest from the date that the money had been taken out of the bank account. And SARS was also ordered to pay the applicant's costs of the application. So a little bit of good news for taxpayers at the end of the presentation, that here's at least a situation where the taxpayer was successful. But it's quite interesting. So I think the key points to take note of here, because it's always a little bit of a terrifying prospect that SARS might appoint your bank as an agent and take money out of a person's bank account. But remember that one has to go back to process. Has SARS followed proper process? First of all, there must be a valid assessment that has been issued with a due date. You must have passed that due date so that it has been an amount that is outstanding. Then SARS should issue a notice of the amount that is outstanding, and a final demand has to be issued before, and at least 10 business days before they can issue the IT88 notice of appointment of an agent. So it's important to pay close heed to this. And if SARS is doing any of this without following proper process, then their actions are null and void and they can be struck down. Of course, the problem is that this had to go before the High Court before the taxpayer was able to get this declaration that SARS actions were null and void and that the amount had to be repaid to the taxpayer. So it was an expensive process that the taxpayer had to follow. But at least they were successful in getting that amount paid back from SARS. Okay, and that is the last tax case. So it does bring us to the end of the presentation. You've all been very quiet, apart from those few questions that have come through, nothing else. But if you do have anything else, please pop them into the chat box or or else just email W.consulting afterwards and I'll see if I can pick it up for you. But otherwise, just to thank you very much for joining me today. I hope this has been valuable time for you, a useful time, and that there's lots that you can take away from here that will add value to your daily work. So thanks very much to everybody. Enjoy the rest of the day. Stay safe. And as we look forward to the move to level 3 from Monday next week, and at least our lives become a little bit more bearable, and we can go out and actually go and travel around to the shops and do things, not anything, but we still have to behave responsibly and safely. So do take care of yourselves, travel safely, be well, and see you again at our next tax update. Thanks, everyone. Goodbye.